Hey guys, I just wanted to jump in for a second and let you know a little bit about today's live stream sponsor, DNA Funded. DNA Funded has very generous profit sharing up to 90% and 3 different unique challenge types. For those looking to get funded, they also have speedy payouts, unlimited trading days on the first and second phase of their challenges, a very wide list of different things you can trade with over 800 different assets tradable, and maybe the most important component, a very experienced team behind the whole operation. So if you're interested in learning more about DNA Funded, click the link, check it out, see if it's right for you, and make sure to do your own due diligence to see if what they have to offer fits your trading style. For 20% off, you can use code A1T20. Again, that will be 20% off any of their challenges you'd like to check out. Thank you again to DNA Funded for sponsoring today's live stream. Now back to the show. All right, good morning, everybody. Welcome back to another live stream. Hope you're doing well. Hope everybody can hear me and see me okay. Just wanted to make sure. Oh, what happened to gold here? Gold was up this morning, just dropping here as we get started today. We'll be talking a little bit of everything on this stream. Hope you guys had a nice weekend. And let's stay safe in this crazy market. Everything very, very volatile here recently. Okay, as we get started, let me just really quick drop the link for anybody who was interested in the offer that we just showed up on the screen with DNA Funded. If you're interested, all the information to get those discounts on challenges can be found here, a1trading.com/prop-firms. You can find our latest special offers and deals with our sponsors there. I just dropped that link in the chat in case you wanted that. Okay, so first of all, S&P 500 slightly red, but honestly came back a lot from overnight. You can see, well, not a lot. We just had kind of the drop here. We rally on Friday, a little bit of a give back over the weekend. It's crazy how used to just high volatility we are starting to get here in just the last few weeks. The volatility index is where I kind of wanted to start today. Volatility index topped out. Did it hit 30? It hit 2950. This is, of course, an indication of market volatility. And what we saw here was the VIX got really high, really fast. And typically, the way I look at this is that when everybody gets scared, the risk premiums start to get attractive. Now, if you don't know what a put is something that you can buy in the options market. It's a bearish bet. Basically, you're saying you think something, whatever the underlying is, let's say it's the S&P 500, you think that the market's going to go down in the next, let's say, 1 week or 1 month or 1 year. You can buy puts for different time durations. Well, if everybody wants to buy puts, if everybody wants to bet that the market is going to go lower, which is what we have seen recently, everybody flocking to buy puts, what happens to the value of those puts? Well, naturally, supply and demand. If everybody wants to buy puts, the price of puts goes up. Now, not just puts, but also calls. If the market is expecting a big move, right? If the market is scared, they typically expect the market to move more. Well, the reason I'm bringing this up is because the market has been getting very scared here recently, and puts skyrocketed in value. That is until the last few days where they dropped back pretty aggressively. But my point with showing you this is that nothing is easy, right? So a lot of people, I've had just comment section guys has been crazy. The bears are back in 2025. People who are saying, oh, no, the market's going to crash. This is the year. Maybe they're right. And eventually they will be right. It's just the problem is they've been saying it for 15 years straight. So here's the thing. When everybody wants to bet, this is why even shorting the market is not easy, right? Nothing is easy. Nothing in trading is easy because even if it's so obvious, quote unquote, that the market is going to go lower, well, the problem is everybody buys puts and the value of those puts gets very expensive. Now, why does that matter? Well, it means that if you're betting that the market goes down, it has to go down a lot to pay back the cost that you put into buying those puts. Does that make sense? I hope it does. I know it's a little bit confusing for If you've never, really learned much about options, I understand that that could be confusing. It's basically just saying that when everybody wants something or thinks something is going to happen in markets, the risk to reward gets really squeezed out of it. Lee says, asks a great question. Nick, at what point does a correction turn into a bear market? Great question. So on a technical basis, a correction is anything before 20% down. So right now we are in correction territory. I'm sorry, 10% is a correction. So we've bounced back a little bit here. 20% is considered by most standards to be a bear market. So are we in a bear market? No. And I've been very adamant about recently saying that I think this is your garden variety pullback. I think most people on the internet you listen to, a lot of them are going to say, they're going to feed you the bear PO, what in. Okay. That's what's selling very well is people who are, the news medias, right? They're all telling you it's the end of the world, right? That is what is selling right now. You have the choice to be a buyer if you want to, go for it. But in my opinion, I don't think that, tariff negotiations are going to lead to a massive market crash like the likes of 2008, right? That's what it seems like the market's trying to tell you, or not the market, the news media is trying to tell you. Well, I've looked into some stuff over the weekend, and I thought it was really interesting that amidst all the negative headlines and fear that is being sold to the market, institutional money bought the heck out of the S&P and the Dow. Isn't that interesting? Headline media, it's crashing. Trump's going to blow the market up. It's the end of the world. It's the end of days. Institutional money buys the dip. Really? Come on. It's just crazy how much they can just manipulate. Anyways, the news media, they're just doing what gets clicks. Look, I'm guilty of it too. My videos where I put something on the title, oh my gosh, the market's freaking out, get way more clicks. I'm not going to lie. I do that too, because it gets people to watch my work. If I don't do that, I get half the views. And why does that matter? Well, number one, I'm running a business, but number two, I genuinely believe that the content that I'm putting out, maybe this is hubris, but I think that it can benefit people. What I share, I believe I'm giving my all to the trading community to share what I have learned and what has helped me in the trading, my trading career. So I want more people to see my message. So I kind of have to do it too, right? But everybody does that, right? That's the point, is there's just so much fear. What I'm saying is dial it back, right? Don't freak out and just understand that what we want to focus on is the data. And I want to show you some other data that's really important. The put to call ratio. I know I'm a broken record recently. If you've been watching my streams and videos, I oftentimes repeat myself, but it's on purpose. Somebody said, Nick, you need to just do one video a week because you just say the same things. And I said, that's a pretty good roast, not gonna lie. But I would disagree strongly, because I actually think that reinforcing this stuff every day, whether it's you as a listener of these videos, whether you agree with me or disagree with me, let's have this forum. Let's do it every single day, because it really bakes in the point, right? We want to really nail in the reasoning behind what we're doing as traders or investors. So I look at this and I say, look, put to call ratio, still very extreme. People are out there buying the fear, right? One of the best salesmen out there. I appreciate that. Genuinely, I do have a passion for sales and marketing, if you clearly know on the stream. I talk about that all the time. I always have something for sale, but I always also mention that what I sell, I personally believe in myself. Always. It's a principle. Nothing wrong with being a salesperson, but I believe that if you're going to sell something, you should sell something that you personally would buy and believe it's worth the money. How to use the smart money indicator? Yeah, let's look at it. So the smart money indicator on the Edge Finder It's pretty cool because what it does is it basically loads in the institutional positioning versus retail positioning for key assets and charts. So let's just see, for example, let's do S&P because I'm on an indices kick recently. So institutional money is buying and retail is very, very bearish, right? So the way I'd look at that is when we see convergence, that's not as interesting. But when you see divergence between what the crowd is doing versus what institutional money is doing, I find that to be a really useful indicator. But personally, I know that the smart money indicator is popular because you can look at both at once, but I personally like to look at them in isolation. So I'll look at first the put to call ratio, which I believe is one of the better ways to gauge the crowd sentiment. So right now, and by the way, we have put to call ratio for gold as well, right? We know there's a lot of gold traders. A lot of gold traders are very scared actually buying puts. Interesting. High demand for puts here on gold recently. So if we go to S&P, right? There's a lot of people out there who are fearful about the S&P 500 and they're paying premiums that are very high for S&P 500. And the reason I point that out is retail getting really loaded up on bearish bets sets up a perfect storm where you have institutional money getting long and retail getting scared. That combination is beautiful. I'm looking for breakouts this week. I've been pretty clear about that in my video on Sunday, and I'll continue to say so in this video. I am looking to actively add longs to my bullish positioning in the S&P 500 and the NASDAQ. Let me show you something on the indices, okay? Nick, they're neutral. Why would you get long? Fair point. Fair point. I'm not long yet. I'm looking for the trend column. You see this? I'm going to show you how the Edge Finder functions with the trend column. It's really simple. I'm going to add on to my chart here the trend saved thing that I have here, which is our A1 momentum indicator. And here's your settings. If you have the A1 momentum indicator, you can add it to your chart too if you want to keep it the same as the way I do it. 3 and 14. Why 3 and 14? Well, that's what the Edge Finder uses to calculate trend. The trend score in the Edge Finder is really basic. It looks at momentum. When this is red, basically, it's a bearish trend. When it's green, it's a bullish trend. Now, +2 scores or -2 scores happen when the direction is down, but also the slope of this orange line, right? The trend slope is negative. When both of them are going together, it gives you a +2 or -2, depending on the direction. So here, for example, let me give you here's an example of a very bullish +2 trend score on the Edge Finder would be, we've got the film going up, right? Green film, but also slant of the line is positive. That's what I'm looking for in the S&P 500, the NASDAQ, because guys, look at this. You ready? If you get a flip from -2 to +2, let's say that we get the flip on trend. Sorry, guys. I know we have news. Let me just pull up our all markets for a second. If you get the flip, those things are going to get bullish scores. This morning we had retail sales, I believe. Is that right? Yes, it is. Retail sales came in a little bit light here. Core retail sales came in as expected. Core retail sales, but retail sales in positive territory. That's better than last time, which was negative. But forecast was missed here once more. Gold liking that. Dollar disliking? Yep, dollar dislikes that. But again, core retail sales came in line with expectations. Gold, here's your 15-minute candle. Not too much of a change. Gold ran up here this morning, pulled back pretty sharply. What's gold at today? Up 0.23%. S&P 500 is flat on the day. Sorry, guys. I know I want to finish that point that I was making because it's really, really important. Probably top of mind for me this week was I was about to get ready to tell you about how bullish I am on the indices if they break out. Anyways, minus 1.2%. They revised the previous number lower. And they revised the previous core number lower. Pretty weak. Not great. Retail sales definitely not hitting this morning. You had weakness in the month-over-month retail sales number, minus 1.2%. So they revised the previous number, which was already a miss. They revised it lower. So not great retail sales numbers. And this is not what you want to see, right? That's not what you want to see. But you can see the market doesn't seem to care too much about it. S&P 500. Let's see. Are yields lower? There must have been something in that report that offset a little bit of the concern, because those, I mean, yields are not moving much. Dollar index, yeah, you can see it's not a huge move. Adds to possible stagflation, kind of, but last week you had really good inflation data. So I wouldn't say that. I think stagflation got pushed back a little bit with the inflation data coming in great last week. Let me show you what I'm talking about. The thing with stagflation, by the way, check out the new USD and stocks impact down here. US dollar still looks really weak. But when we take a look at inflation data, which by the way was also weak for the dollar, inflation came in last week 2.8% compared to the forecast of 2.9. That was a good beat. PPI, the producer price index, came in lower than forecast. Another nice beat. Both of those factors bearish for the dollar and good for the stagflation story, right? Not like meaning stagflation is rising inflation, weakening economy. The thing is, last week I really had a pivotal change in my sentiment in the market for stocks. I went from like pretty neutral to now bullish, because inflation cooling takes away one of the key, if we're looking at a chessboard, the chessboard opened up, right? Because inflation cooling gives the Fed ammunition to cut rates and save the day. The Fed put seems to be back on the market. That's my opinion on it, and that's why I actually think stocks can continue to go higher. Or not continue, but start to go higher. They've been getting crushed recently. I think that they have potential to push higher because the Fed put is back in the picture. Okay, let me get back to my point here about trend, because again, it plays into what I just said. So inflation data, you can see it in yellow text. We added this cool filter. The yellow or orange text here shows recently reported data. JOLTS job openings were strong, stronger than expected. Jobless claims last week held in very nicely. This is not signaling recession, by the way. Unemployment claims are not signaling recession. If this was up in 300s, 350s, yeah, that's recession. 220, no cigar. So again, the headlines will have you believe the market's falling out of the skies. The data suggests it's not horrible, it's not excellent. But in what world is a mixed report, oh, we're going into a recession and the market's going to crash? That's the difference. There's a spread there. That is where I think the risk to reward looks very good for stocks, in my personal opinion. In my personal opinion, the data is saying, and the headlines, the news is telling you it's going to zero. That's where the opportunity is. Now, I want to say something, because I was speaking to my wife about this over the weekend. I was recalling that one of my best trades, top 5 kind of calls in my trading career, and I'm not always right. Look, I know I'm not always right. One of the top 5 calls that I made in my career was when everybody was terrified that Biden was going to crash the market to zero, that inflation was going to go crazy, and that it was all Biden's fault. By the way, inflation was a global phenomenon. It was not isolated to the US. And I find it, on behalf of my friends all around the world who experienced much worse inflation than the United States, I find that offensive. But But I'm gonna reel this back in because this is where politics drives me crazy when it comes to markets. People bring their politics into their trading with them. Look, when everybody was afraid that inflation was going to go to the moon and that Biden was going to crash the stock market, there was some wonderful risk to reward opportunities to get long. I see a similar scenario playing out right now, and I could be dead wrong in front of YouTube right now. I don't care. Like I do this. I've done this for years. I've been right sometimes. I'm wrong sometimes. But the risk to reward right now, where the whole world is chanting that Trump's going to crash the stock market because he's renegotiating trade, I find that to be silly. I find that to be, I don't know about all that. Maybe the market does crash. Maybe we do go into a recession. But I believe, just like when Biden and everybody was afraid of inflation causing a stock market crash, right? The risk to reward starts to become really, really attractive. What I'm talking about is the risk to reward to US equities and indices. Now, again, I could be wrong. I'm not saying like there's also been times where I've just been dead wrong. There's times that I was bearish on gold. Here's a time where I was dead wrong in front of YouTube. I was bearish on gold, like right around here, right? I flipped bullish after that point. At a point, I started looking at, inflation data, and I looked at, the inflation was coming down, giving the Fed the right to cut rates a lot easier. I changed my tone on gold, but I was dead wrong on the onset of this rally. So please understand, I will do my best to point out when I'm right and wrong. I find it really frustrating when traders never on social media talk about when they're wrong. I'm wrong often. It's part of trading. It's about what you do when you're right and what you do when you're wrong that makes the difference of profitability or losses. So, here's my take on it is I think that the risk to reward for indices looks really good. However, going back to what I was discussing earlier, if you like it so much, Nick, why are stocks and indices not getting bullish readings on the Edge Finder? Well, this is the beauty of being a systematic trader, okay? When you're systematic, when you have a rule set, the Edge Finder is a rule set. When a top setup generates, it has to look at all of this data, economic data, technical data, sentiment data. And no matter how hard I try to want something to be bullish or bearish, at the end of the day, the data is what determines if it is or not, right? In my system. That's why I love being systematic. The trend filter, if that flips, if we get a bullish breakout this week, SP500, NASDAQ, those things are going to go from neutral to bullish. The threshold is -5 and 5 on the Edge Finder. Okay. So if it is greater than or equal to 5, bullish. That's the way the Edge Finder scores. If it's less than or equal to -5, it's bearish. That's the way the score mechanism works. So if you get a +2, that's a factor of 4. That would take us from a +3 to a +7. That would be a bullish rating. And from a trading perspective, that's where I get the permission from my quote unquote system to start looking for longs. Does that make sense? So again, my gut right now says just rip the Band-Aid off, go long NASDAQ, go long S&P. That's what I'm doing. That's what I'm like interested in doing. But my system might keep me out of some trouble. We're still in some bearish momentum here. Right? Let's face the facts. This chart still looks pretty ugly. And there is the possibility that we see sellers step in and push this thing lower. From a long-term perspective, where I've been buying shares for the long term, I actually hope that happens. From a trading perspective, what I'm looking for in terms of longs would be a breakout of key resistance. And most importantly to the Edge Finder's calculation, a flip from red to green, right? A simple flip of this scenario would get us into territories where I am looking for aggressive longs. Not silly risk management. I'm not saying inappropriate, stupid buying calls with all my money. That's not what I'm saying at all. What I'm saying is aggressive in the sense that this is still kind of a downtrend, but on a break and potential reversal of that downtrend, I'm very interested in the risk to reward at that time. Does that make sense? We just had a yen movement. Somebody pointing out yen. Oh, interesting. Here's what's just happened with the yen. Swiss yen, Kiwi yen, Aussie yen. My euro pound short setups. I'm dollar cost averaging on this. Here's a trade that's not going super well. Let me just oust myself here. I shorted euro pound. Oof. Fortunately, it was a really small position. I added a second really small position, and I had a third very small position. I'm dollar cost averaging on this, which just basically means I have, instead of going all in on a one singular trade with a tight stop, I just have a small risk here, small risk here, small risk here. And I'm actually hoping that it keeps going. I'd like to fill some longer term, but this is an example of a trade that I'm just dealing with. Swiss yen has also been kind of frustrating. I've been short on Swiss yen since over here. I think I'm about break even. So after all this time, break even on the trade. So admittedly frustrating. What's working well for me is I'm still long gold. My stop loss has been trailed into profit. And actually, I'm going to just change this really quick to a support level. So we still look good on gold. Like I said, I'm fine with it pulling back. I just don't want to see it break support, right? If we come back and test this area, I want to see buyers step in really quickly. We are sitting at an all-time high. Whenever we're trading into all-time highs, I'm typically just looking to trail my stop and try and let that trade run. You know what's crazy is I put my yearly target for gold at 3,000. Gold has just shocked so many, including myself, at how bullish it has been. I've been bullish the last 2 years primarily on gold. Ever since the Fed kind of paused and started cutting rates, I've stayed pretty bullish on gold. But it just keeps shocking everyone how fast and how far it can move. I mean, look at gold in the last few years. The thing is a beast. The thing is an absolute beast. But I've got a stop loss trailed on this one. And I think that if we get something like this week, if we continue to put new legs higher lows, from here, I'm just going to continue to manage the trade. This is another thing that I was thinking about on the way in, on my drive in to work today. I thought about this. I thought, part of me wants to, my gut has been wrong recently. My system has been correct. My gut has been wrong. Let me explain this. I thought about this on the way into work. I thought about it over the weekend. I was like, man, there's been several times recently where I've been like, I should just sell my gold positions. I own positioning in GLD. It's an ETF. So I have cash sitting in GLD, right? My gut reaction the last few weeks has been to sell that and use it to buy more stocks because they're down. Well, my gut has been dead wrong. It's been early. Now, I have a portfolio, a stock portfolio, brokerage account where I have, margin in the account. And a lot of my margin is still tied up in gold longs. So when I say staying systematic is a theme that I'm absolutely staying with this year. I'm always systematic, but this year I'm becoming more systematic than ever. I am truly, genuinely staying so true to the Edgefinder findings, proper setups, managing my risk. Well, my gut has said sell gold, buy stocks. But it didn't say that today. I mean, had it said right here, obviously that would have been right. It's been saying that since over here. But I haven't done that, right? I haven't sold gold. I've actually stayed systematic, and that has been the right call. Gold continues to impress, even myself. Like, I've been bullish on this thing, but it continues to impress everyone, including myself. So what I mean by this is that my system, my rule set has kept me in this trade, despite my intuition, which is important in trading, but needs to be checked by a system, in my opinion, has kept me in gold. And I'm going to continue to respect that because it's what's working well this year. I'm actually positive on the year, whereas most stock market indices are down. I mean, the NASDAQ was down like 10+% recently. So when I say staying systematic, my goal is to continue to trail stops and let the market tell me when it's time to get out, not my intuition, or not my gut is a better way of saying it. Intuition is important in trading, but making a drastic call like, oh, sell gold right now and go put it all into stocks, that's not what I do. That's not what has been effective for me over the years, right? Am I looking at stocks closely? Yes. I'm looking for opportunities to get long, but I can't abandon the gold trade. The gold trade's what's working, right? A lot of the stocks that I have been buying, I bought too early, right? I bought stuff over here, like individual stocks. Like I've been buying singular shares like Tesla and Amazon, Google, companies that I like. But I've held back on index, getting into indices long because, again, staying systematic, I'm waiting for these readings to go positive. And gold, let's add in metals. Gold is still a bullish reading. So again, I'm just following the system, staying true to what is working. By the way, guys, quick little PSA. We are going to be doing a Edgefinder giveaway this week. So if you would like a chance to win an Edgefinder copy, let's do this really quick. Here's how you can join for a chance to win a copy of the Edgefinder. Okay. Ready? It's free to join. Step 1, join our Telegram channel. You should do this anyways, because at the end of the day, we share a ton of free value in our Telegram channel. We post bonus clips in the Telegram, bonus charts, markups, analysis, memes. What's not to love? So take a second really quick, join the Telegram channel, because we are going to be doing some Edgefinder giveaway stuff here this week. Is it for 1 year? No, we're giving away lifetime. Lifetime access to the Edgefinder is going to be given away to somebody who is in our Telegram channel. More instructions will come in the Telegram. So if you're very interested, take a second. And like I said, I want to share some more free value with you. Our team puts out, Julie, Frank, myself, we put out a ton of content for traders. We put out tutorials. We put out, here's like Frank's decline on oil chart markup. He puts out articles. He writes research for us. So again, there's a ton of value in the Telegram. Just take a second really quick to join that. And we're going to be doing a giveaway for the Edgefinder. I want to join now, but your Telegram has 39,000 people. Why not join then? We have plenty of people in there. We're trying to get this thing to 40,000. I think it'd be cool to get this thing to like 50,000 or maybe even go to 75,000 by the end of the year. That would be awesome. The more that channel grows, the more we're going to do giveaways. So yeah, there is your chance to enter the giveaway. Just join our Telegram channel. We'll have some information there. Check out the Bitcoin to gold ratio, guys. This is also really something kind of fun. So gold has been performing really well. Compare that to Bitcoin. Bitcoin's not been doing very well. Well, you can actually compare the two. The Bitcoin to gold ratio shows you that when this chart, and I love this chart because it gives you some interesting insights. When this chart is going down, what is that telling you? When it's trending down, it's telling you that investors, traders, the market is buying gold aggressively as opposed to Bitcoin, right? So when you get that divergence between the two, we would call this risk off. For those asking about how the giveaway will work, like I said, details will follow in the Telegram channel. Just make sure if you haven't joined the Telegram, it is free to join. Information will be shared there soon. Again, we're giving away an Edgefinder copy today. You have plenty of opportunities to join that. It'll be shared in the Telegram in just a bit. So if this chart is moving down, this is a great indicator of risk off sentiment in the markets. When people are buying Bitcoin aggressively, it's usually a risk on market. When people are selling Bitcoin and buying gold, this chart moves lower, and we call that a risk off environment. I just find that to be a really good indicator. So we are still very much in a risk off environment. Gold has been interesting here this morning, putting in some wicks here off the top. Let's see if those either turn into a bigger pullback here, or if we can stay holding those gains. 4-hour chart, again, we were in this consolidation phase, broke out, and I trailed my stop loss just below this kind of low, right? This bull flag push to the upside. I put my stop just below that. I'd love to see if we can get something like this, another higher low, be a good opportunity. NASDAQ here, like I said, has a lot of work cut out in front of it. But what I'm looking for on the NAS is a breakout, pullback, breakout, pullback. If we can get that this week, we have a Fed meeting this week. If that's what you start to see form, I think the risk reward there looks really good. So let's take a look at the COT report also this week. Sold Nikkei heavy, 10-year treasuries, South African Rand, CAD, Aussie, Swiss franc. They also sold a little bit of gold. Actually, sold a good bit of gold. Sold gold long contracts and added a small amount of short contracts. So Rob, thank you very much for the 100 rupees. Hello, Nick. Yen is a very interesting level and finding support around current price. With the Bank of Japan to keep rates unchanged, what's your opinion on the yen? Well, my opinion on the yen. Let's take a look. By the way, thank you again for the donation. I appreciate that. So that's UK. Why are we on? This is totally messed up. Look at this. UK, but it's in JP. I don't know what happened there. This is, let me see. Is this Japan's data? Ignore that. We'll get that fixed. What I've noticed, or one thing that I'm curious about with Japan is that, okay, you have high inflation, and still the data tends to support, in my opinion, hawkishness from the Bank of Japan. While we may not have gotten that, I still think that's a reasonable story. So if I look at yen pairs, especially something like dollar yen, this rally personally looks more bearish to me. You know, you've had some momentum to the downside here. If sellers are going to hold it, it looks like a pretty interesting spot where we currently are. This is a daily chart downtrend that we've been in. The US dollar specifically looks pretty weak to me. I mean, it has been weak, so maybe it's due for a bit more of a bounce. But you take a look at the dollar impact on the economic heat map. What that's telling you is that most of these indicators that we look at are suggesting bearishness for the US dollar. So, for example, on manufacturing PMIs, we had a negative surprise. That's not so good. Services PMI was good. Retail sales, weak. And by the way, came in and missed again today. Once that updates, you'll see that data in the Edge Finder. Inflation last week was very soft compared to forecasts, which was good for the economy, but not so good for the US dollar. Wage growth was a little bit softer than expected. Unemployment rate was good, which is bearish for the dollar because that suggests that the Fed could potentially cut rates if unemployment looks good, right? So the dollar overall looks pretty bearish to me. So if I'm looking at dollar yen, right? which also has a bearish setup in the edge finder, if I believe. Yep. Yeah, this looks like a bearish setup for me. I may actually take that trade today. I'll keep an eye on it. I'm going to watch how the candle closes today, watch how it, or at least how the candle on the lower time frame closes. But I may take a trade on the dollar yen. I think that this actually has more potential to move lower. Weaker dollar, stronger yen has been a pretty good theme this year so far. Maybe the Bank of Japan is looking to stay as dovish as possible, not to disrupt the global economy. That's been a theme. They've tried not to disrupt everything by hiking rates in the last year or so, but I do still think the Bank of Japan most likely will hike rates. Oh, the Bank of Japan did hike its rates, but maybe they signaled. Well, so what was the news here? Because we had Japan. Was it like a dovish hike? Is that what we got? Let's see. Inflation provides the Bank of Japan with more room for future rate hikes. The yen benefited from broad dollar weakness as U.S. economic concerns and shifting trade policies added pressure on the greenback. Interesting. Yep, that's right. We have the Bank of Japan this week. Gotcha. Yeah, so I mean, like I said, I think that most things here still suggest some yen strength. That would be my perspective on dollar yen. S&P and NAS are in the green here today. Like I said, probably my most watched chart right now is the NASDAQ and S&P, these two. I'm also watching gold, but there's little for me to do here other than just to continue to trail my stop. So if gold gives me one of these, amazing. I'll just keep trailing. But there's not really, I'm not looking to add to gold and I'm not looking to take profits. I'm just looking to trail stops on it. TLT slightly higher this morning. We can talk currencies for a second too. Here's a look at, I really like the euro and the pound on the bullish side. In fact, I put something out in our group. This was my memo yesterday. So watch list this week. These are what I'm looking for bullish setups on. Euro dollar, pound dollar, S&P 500. Bearish, I'm looking for oil, dollar yen, CAD yen, Aussie yen, euro pound. So that's kind of my watch list. I usually share that, or I try to share it every week in the Discord group. But that's pretty much what I'm looking for. So for euro and pound, I actually like pound a little bit more. A pullback here would be really interesting. So if you get pullback into like the 1.2775 level, I like that for possible long continuations on the daily. But I've been waiting on this for like a week and a half. So, just waiting. But I like the pullback opportunities here, long side continuation for pound US dollar and euro dollar. And the difficulty with the US dollar is that what we just got done discussing. Look, most of these things on the US dollar impact are showing bearish. You had some decent jobs data, JOLTS and jobless claims last week. They were good, which is positive for the dollar. But the big thing that you lost last week for the dollar was inflation really came down more than people thought would. So inflation came down, making the US dollar pretty bearish, at least on our economic heat map here. So when I look at the dollar, I say, okay, well, what do I want to trade it against? Well, the UK has been pretty upbeat, right? This is the power of these new economic heat maps. And I love having this. I was doing this last night when I was looking at some FX trades. I love being able to just select the heat map that I want to look at and just see the score here for the currency and for the underlying stock market there. So the UK right now, most of our indicators here are suggesting bullishness, right? Inflation higher than expected. GDP kind of missed, but there's a bit of recent uptick in hawkishness from the Bank of England. And again, you can kind of see why a lot of these data points coming in a little bit hot. So some bullishness for the UK in terms of the pound. And so when I look at the pound against the US dollar, the euro against the US dollar, especially with all that weakness for the US dollar, I kind of like the idea of possibly building a little position long on the euro. So that's my take on it right now. As I'm watching for euro and pound setups. I'm trailing stops on gold, looking for breakouts on indices. I have a pretty active watch list right now. I haven't gone over oil too. Oil, I'm looking for pullbacks here. Let me see if this is still getting a bearish reading. Nope, it's not. Oil was a bearish reading, but no longer. So I'm probably just going to skip that one. So yeah, it really is. This is pretty much still my watch list right now. Euro, pound, S&P, bullish setups. And I should revise this. Probably going to pass on oil. So dollar, yen, CAD, yen, Aussie, yen, euro, pound. So if I take any of those trades, it'll get shared inside of our Discord group. If you're not already in the Discord, send us a direct message if you're interested in joining. We'll get you set up with a stream discount if you send us a DM, or you can head over to a1trading.com/VIP. That's a1trading.com/VIP. If you're interested in exploring our memberships, you can join and get access to all the trades that we're sharing throughout the week. US stock market opens up in 25 minutes. We'll see if that brings any kind of interesting moves. The US stock market opening up usually brings a lot of volume with it. So we'll see. Nick, what's up with the red and green S&L zones? Yeah, so basically I just, if it's a resistance level, it's red. If it's support, it's green. So these would be levels. Like if we take a look at euro, that's a interesting one. Like euro, you have resistance overhead, support below. And I like to mark out my zones this way. There's nothing magic about this. I think it was last week or the week before I ranted about how somebody asked me, like, they could not understand. They were like, how did you know? So this was what it was about. It was about gold. Somebody was asking me about my gold trade. And they said, Nick, how did you know that that was going to go up? Like, how are you sure that it was going to go up? And my answer might frustrate you because I wish I did know, but I didn't. And it frustrated this person too. They did not like my answer. This was somebody in our Discord. They sent us sent me a direct message, and they said, Nick, how did you know that that level of support was going to hold? And I said, I didn't know. I made an educated guess. I like the fundamentals. The fundamentals made up most of the reason why I went long gold. And they did not like that answer because people who, and this is the common gripe that people have with fundamentals, is fundamentals are abstract and more difficult. They just want to know, show me a technical level that I know will hold. And I just get frustrated with that question because, man, I wish I knew a technical level that was easily always going to hold. Our life would be easy. Everybody's life would be easy if you had an easy technical signal that worked every single time. But I like the fundamentals. And then I overlaid a technical support level that I liked and I bought and it went up. But there are times where I buy this same exact setup and it fails and I lose money. So the reason I point this out is because everybody wants that, easy answer of like, how do I know that this is going to go up or down from levels? And there is not an easy answer. There's not a simple technical trading strategy that is just going to print money easily all the time. Everything works sometimes and doesn't work all the time. Fundamentals to me are far more important because they add kind of that context to why we might want to be long or short something. That is why I spend all this time talking about economic data. I do it for fun too, but it's not all for fun. It is because I find it to be really, really important stuff when trying to interpret, is the dollar bullish or is the dollar bearish or is a stock's poised to go higher, et cetera, right? Like that stuff is really important. But this question of, Nick, how did you know this support level was going to hold? Like I said, the answer is I didn't. I did not know that this support level was going to hold. So when I show you these levels, I know that technical charts can be mesmerizing to look at someone's charts and say, oh, I love those zones. Those zones are so perfect. But again, I would encourage you not to fall into the trap that most traders do, which is obsessing with technical analysis and treating it like it's some sort of holy grail. Technical analysis is like, it's just a lens to look at the market through, but to me, it doesn't have massive predictive power. Fundamentals help me to spot true market direction, and technicals are just red and green lights. In this case, literally red and green lights, right? I hope that makes sense. But again, like I said, one of the most common trading mistakes that I've seen is people obsess over technical analysis and they underestimate or completely rule off fundamental analysis. And I think a lot more traders would benefit. One of the first things fundamental analysis will teach you, if you are new to trading, fundamental analysis, the first thing it will teach you is it will humble the absolute heck out of you when you start going down that rabbit hole. Because what's going to happen is you're going to say, okay, well, let me take a look at what CPI really means. And then you're like, oh my God, there's so much to this. And then you say, well, let's take a look at labor data. Are jobs strong in the US? And then it's just this rabbit hole of understanding the labor market data. And then you understand, well, what's the Fed going to do next? And that's just this monstrosity to understand. What fundamental analysis will do, and it's one of the most powerful things that it does for you, is it humbles the absolute heck out of you. I come to this stream like everyone else, looking to learn because I'm never going to stop learning in the markets. There's so much to understand. There's so much to learn. And I would encourage you to embrace, I know a lot of people are like, oh, just keep it so simple and just mark up your charts and trade. And I get that. And if it works for you, then don't listen to me. But most people are struggling to find consistently profitable approaches to the markets. And I think fundamental analysis offers a lens to view the markets that really are eye-opening for a lot of traders. Fundamentals are so humbling when you start realizing how complex the whole system is. You're like, whoa, I'm not a genius, and this stuff is harder than it looks. Nick, could you send over the link for today's? Yes, James, sorry about that. Let me send you this link. Usually Chandler or James did it, so sorry about that. There it is. Just sent it, James. We have James joining the show in just a moment to take over, which will be fun. So anyways, like I said, it's really, really important to me to spread the word of fundamentals, because what happens is it humbles the heck out of people, humbles the heck out of me to this day, right? Every single day. Fundamental analysis keeps you honest. You're like, as you try and learn this stuff, you're like, holy crap, there's always more to know. Second you think you know something, there's more to know. And when you approach the markets as a student rather than an arrogant jerk, things start changing for the positive. Nick, could you add a sentiment overview to the economic heat map? Well, for the economic heat map, no, this will stay economic data. If you want kind of an all-in-one, head over to your EF scanners, head over to your selected thing, and here is your summary of all of the data in one spot. So there is already something like that that combines everything. But Lee, you might have just triggered something in Lee James. Lee James. What you said there, what I thought you said was, could you build a sentiment heat map? And now you've just got the gears flowing. Why'd you have to do that to me, James? Why'd you have to do that? Now I'm going to be up till midnight all week. No, actually, no, that's a great, I don't know if you meant to ask it this way, but the way you asked this question, I thought you said, can you add a sentiment heat map or sentiment overview heat map? And I think, can I ask the audience really quick? Would that be a good idea? Would you like so we've built economic heat maps. Do you guys want sentiment heat maps too? Edgefinder users, type yes in the chat. If that is something, and again, I use this, so please, if you're genuinely wanting that, type yes. If you're like, not really, then don't type yes, because for the sake of my sleeping, please don't force it. But I don't know. I'm curious. Sentiment heat map, would that be cool? We'll look into that. I feel like that's pretty cool. That's a cool concept. We have the economic heat map. It summarizes all the economic data in one place. Maybe we could build a sentiment heat map as well. If only Nick wants it. No, White Bear. That's not how I do business around here. Genuinely, the Edgefinder has gotten so good because we survey constantly what the crowd wants to see next. The Edgefinder has been led by the community, which is the cool part about it. I like to look at the Edgefinder as kind of like a conglomerate. It's kind of a summary of what people who want to know about fundamentals have been striving. They're hungry for, right? Heat maps are the biggest update for me. Yeah, Bashy, me too, honestly. To be completely honest, like the heat maps are my favorite thing in the Edgefinder. The most popular tools in the Edgefinder, I could tell you guys this because, again, like I said, we survey and we ask our customers often, like, what can we do to make this thing better? This is cool to me and really exciting. And I hope that this actually changes even more. Number one is the top setups algorithm. People love the top setups algorithm. Number two, people love the sentiment stuff, but specifically the COT data is really popular. Cool. Makes sense. Those are great indicators. Those are great tools to have. Track institutional money and get a summary of the Edgefinder's output. Understandable. Number three quickly got taken by the economic heat maps, which to me, I'm like proud because we've not had, all this other data stuff here, economic growth, labor data. These pages are far less interesting to people, but when we summarized it, it took number three, which thrills me. And I hope that with time, economic heat maps maybe even take over that number two spot behind COT data. But we track this stuff religiously. I mean, I'm constantly looking at surveys from our customers, reviews from our customers, because we just want to improve it better and better. So thank you guys for your feedback. Nick, do you code it yourself? No. So real quick behind the scenes, I don't do a lot of the programming. I am a programmer by trade. That's what I went to school for. But what I usually focus more on is the UI. So what shows up at the end case, usually the cosmetics, the colorings, the color codings, the layout of the tool, that is usually what I work on. And then Frank and Giles, our two guys behind the scenes, are more on the thinking through the mechanisms, the functionality, the data polls, all the stuff that goes behind it. So we make a great team, the three of us. But yeah, we each play our role. I'm mostly on the UI side. So plus I've got, the rest of the business and content stuff to run, and obviously trade as well. So it keeps me busy. Anyways, up next, guys, we've got our next show host. He's coming in hot. We got Forex James coming into the show here today to talk a little markets with you guys. So what we'll do here is, I think we have James on our side now available as well to transition for us. So we'll give this a quick run. And with that said, thank you guys for hanging out with me. If you do want to check out the Edge Finder, last call before I step away, we're doing a giveaway this week in the Telegram channel. If you don't have a copy and you would like a chance to win, take a second to join our free Telegram channel. We'll be dropping information on the giveaway today. So if you want to enter for a chance to win, join the free Telegram channel. Thank you guys for sticking around with me. Up next, we got James coming in to talk markets. Stay tuned. If you're someone in the United States looking for a Forex broker, it's been hard to find recently. There's been a lot of changes in the industry, so I wanted to take a moment to tell you guys about Oanda. Oanda is a US regulated brokerage that allows US traders to trade currency pairs like the euro dollar, the pound dollar, the dollar yen, Kiwi yen, all sorts of different currency pairs. So if you're interested in checking out Oanda, we're going to be dropping a link in the chat right now as we speak. They, again, are a huge brokerage in the United States that allows you to trade without the worry of whether or not your account is going to get shut down tomorrow from an offshore, unregulated, sketchy brokerage. They have been around for a long time, and I've used them myself for a number of years. So if you're looking to trade FX and you're in the US, this is the brokerage to check out, in my personal opinion. So take a look at it. We'll drop the link in the chat, like I mentioned, should also be in the description of this live stream. Do your due diligence and see if it's right for you. Now back to the show.
Hey guys, how is everyone doing? Feels like it's been a while, but it's not, I don't think. See some familiar faces as always. Got Bashi, Shadow, Lee, good stuff. Hope you're all well. Hope you all had a good weekend as well. So currently in the Aussie US dollar, it's running quite well so far. So this is off the back of the lower CPI, which is increasing or potentially increasing Fed rate cuts in terms of time expectancy. We've still got trade wars going on, bringing uncertainty to the US dollar, and the general sentiment is just very, very bearish. I mean, if we just look at the way the US dollar has been behaving and the way it's been moving, although it's been pretty much sideways. Please. Oh, sorry, my bad. Well, I've not made that mistake in a while. Sorry, guys. There we go. We're back. So yeah, as I was saying, the US dollar has not really done too much, but the sentiment is still bearish. Definitely not looking to buy that one. So I bought the Aussie dollar to benefit from essentially just bad market on the US dollar side. We're also looking for a little bit of a correction. Obviously, a lot of the US dollar crosses had a pretty major downside since September. So we can see Aussie dollar here dropped just over 12%. So it wouldn't be a shock to me off the back of the weaker dollar that we start seeing some of these dollar crosses come back a little bit, maybe not the full correction, but yeah, I'm starting to look to buy these ones now. Also closed out of Aussie New Zealand this morning for a nice 1.1% gain. Nothing too crazy, but you know, a little bit of profit on a Monday morning is quite nice here. So again, this one is really off the back of the, hold on, let me just check my notes here. So the Chinese economic data is slowing down, downside risk for the Aussie dollar. We've still got hedge funds that are long, but the markets are remaining cautious. The RBNZ, so the central bank for New Zealand, is not too bad. They're cutting rates, but I wouldn't say they're in a detrimental position. But yeah, neither of the currencies are especially bad, but we've also had iron ore that's has dropped quite heavily, affecting the Australian dollar. And obviously trade wars going on as well. We've got Danske Research in their short positions much, much larger. I think they've got to take profit down at 1.2. So they've got a crazy, crazy trade. It's something huge, like down here. No, 1.2, 1.05, sorry. So yeah, I was just following their trade really and adapted it to a smaller time frame. So let me just fix that. There we go. But yeah, that's pretty much it. We've also bought the S&P as well, but that's not really done too much. I've not even marked it up yet, actually, because it wasn't my trade. We bought the S&P around here. So we're essentially going for a one-to-one trade. I don't really know. It's some complex stuff one of my analysts threw at me, so we took it. So yeah, we've got that one running on the portfolio at the moment too. Okay. How's my pizza? My pizza was delicious, although I'm on a diet now. Just did a food order, like grocery order. I got ChatGPT to write me a calorie deficit intensive food plan. I told it to ignore flavor, ignore taste, ignore cooking. So it's essentially just ingredients that I'm going to be living off for the next couple of months. It's things called like a crash diet or something. I need to lose. I've got a wedding coming up in July, and obviously the stag do coming up next month. So I need to lose a couple of pounds as soon as possible. I'm the best man, so can't afford to be coming up representing the traders as being fat. Okay. Run, yeah, I do. Well, kind of. I need to get back into it properly, but no big deal. Sweet. Yeah, there's nothing going on really. I've got quite a wide watch list like I did last week, but there's nothing really that I'm desperate to get into. It's more just things I'm keeping an eye on. So the US dollar SEC is one I was looking to take. I don't really have a solid thesis yet, other than I think it's MUFG is currently long or looking to go long. That's about all I've got. This market, from what I've read, again, it's not something I trade. I stick to G10s really, so it's why I'm not really that excited about going in. But technically, it looks fine to essentially just continue this range trading. It would also reduce some of the dollar short exposure I've got. If we could buy the dollar against the SEC, then if the dollar does have a bullish pullback, then at least I'd benefit from that and I wouldn't go into a total drawdown. What else have we got? Euro dollar is interesting because I'm looking for a pullback here. Now, there's a couple of reasons, and it's not really a huge macro reason. It's more just the way the market's moved. It would tells me that it surely can't go up any higher. And I know that that's very dangerous words, so I'm definitely not actually shorting it just based on that. But again, as we were saying with Aussie dollar, since September, it's dropped just over 9%, and it's regained 6% of that drop in the past 2-3 weeks, which is a large rise. This is, as far as I'm aware, it's the 6th largest move in euro dollar history, and that's including things like the GFC and COVID. So it's definitely not a small move. Now, the reasoning euro dollar had such a large move is obviously off the back of US dollar weakness, but we also had tariffs. We also had the 500 billion euro fiscal stimulus by Germany. You've also got a less restrictive policy by the ECB. So it was, free game really for euro dollar bulls to make money there. But I was reading Credit Agricole's report over the weekend, and it seems most of the positive factors for euro dollar are priced in now. So the only real situation where euro dollar continues to trend higher is if we continue to get positive news. If we don't really see any developments, or if we obviously see worse developments, then it would make sense for the market to pull back. Maybe not fully correct, but some sort of pullback. It could even just be 50%, which would be to here. In that case, I'm not going to short this market by any means, so I'll be just waiting for a downside move, and then I'll be looking to go long. I think the sentiment has changed to bullish, so I'll be looking to basically jump on the bullish band or the bullish bandwagon. But yeah, it's a case of just waiting for some sort of pullback, really. Sweet. Pound New Zealand looks quite attractive as well. Yeah, I'm not sure it's quite ready to enter. It might be later today, maybe early tomorrow, if we can see some sort of rejections. There's 2 entry levels I'm interested in here. We've got the first one, which is actually where it is now, but I would need to see some sort of exhaustion or a bullish engulfing candle, something to confirm that this level is going to hold. So we've got the 200 moving average right here. We've got, coming into this 50% level, we've got previous structure as well here. We've got the Pound New Zealand reading bullish on the edge finder. So overall, it looks like a great long position. However, if this level doesn't get respected and it continues lower, fine, I'll look to buy around here, which is, again, previous market structure. It would also line up quite nicely with this previous trend line. So, keeping it pretty simple. But due to the sticky inflation in the UK, holding off the rate cuts, then I think that's quite a nice sign. We've had the pound actually one of the best performers in the G10 landscape. We've got UK fiscal tightening is equaling to growth risks. We've got the Bank of England easing later in 2025, but that's obviously more of a long-term outlook. Short-term, I think we could potentially pump a little or push a little bit higher, maybe even just back into this previous high. So I'm keeping an eye on it, but for now, yeah, it's not quite ready. I'm just seeing a lot of talk about pizza. I've got to say, actually, I think my favorite pizza place is Papa John's. I love the sauce that comes out, like buttery, garlicky sauce. If it wasn't for the sauce, I probably wouldn't go there, but Domino's is okay. But I think Domino's is really overpriced. We ordered 5 pizzas. I think it was, yeah, Friday. We ordered 5 pizzas, and it came to like £120. I just don't think 5 pizzas is worth £120. Like, you know, it's good pizza, but a pizza costs what, like £5, £6 to make? Crazy stuff. No wonder their stock's pretty good. They just overprice everything. Yeah, Papa John's. I think Papa John's is really underrated, actually. I never really see it get the respect it deserves. Gold, I would still love to go long on gold. I think it's just a little bit too risky right now, as we've just reached 3,000, or we reached 3,000 on Friday, and now we seem to be stuck. It's obviously 3,000 has been a huge level, you know, psychologically and in terms of targets as well. So it's probably a case now of people being a bit cautious to buy gold, but also maybe not wanting to take profits just yet. But it wouldn't surprise me if you do see some profit taken on gold, similar to what we did here. And we see it basically every time we reach a new all-time high. We'll see the market pause a little bit like we did here. Then it'll have a drop off and then it continues. So I'm just waiting. Is this the pause before the drop off and then the continuation? Hopefully so, because then I can get in on one of these pullbacks or wherever it pulls back to. I think that would be pretty much perfect. But yeah, right now, kind of a no-go zone in terms of buying it. I'm definitely not going to look to short gold. You can look at pound yen. Yeah, there's not much on pound yen. I think the overall idea that I would have is go short, but with the pound strength at the moment, I'm just a little bit cautious. If we can remain either in or below this resistance, fine. But the yen seems to be giving up some ground as well. So if we look over here, I was saying last week actually that I think the yen was ready to have some sort of pullback, which is what we're having now. So if we can maybe see it come a little bit lower, fine, I'll look to long. But I've got a bit of exposure to the yen already, so I'm not desperate to get in or really looking to get into another yen cross or, you know, the yen pair. But yeah, long term, I'm more than happy to go short on all of the yen pairs. It's just a case of being patient, because recently, or since I've been talking about this yen idea, I've seen a lot of people going into the same thing and obviously getting stopped out because it's at the moment really just sideways moving. And I've tried to make it very, very clear that it's a long-term idea. I've positioned for, you know, the next year or two. It's not a case of I'm just looking for something like this and that's it. So yeah, although my idea is to the downside, it might take some time to actually come into fruition. So yeah, I wouldn't be diving into it just yet anyway. CAD yen, basically the same idea. I think there's a lot more room to the downside actually on CAD yen. But again, it's just a case of waiting. So if we could get a nice pullback into something like this, that would be great, which actually isn't too far away. So it'd be coming into previous structure, 200 moving average. It'd be a very healthy pullback to continue to the downside. But yeah, I think the yen play is almost perfect. It's just a shame it's such a long period of time, because it's going to take a lot of patience and a lot of adapting in the market really to get it right. Euro Swiss actually is one I really like. So as I've also been saying, along with yen bullishness, I'm actually quite bearish on the Swiss. So last week I took 2 long positions. And they were very, very simple. There wasn't really much behind this. So the first one was just, 50% pullback, as I always do. yeah, reached 50%, and then it pulled back a little bit. So I got in because I missed the initial entry down here. And then the second one was just a case of bouncing off previous resistance, very typical break and retest. I talk about that quite often. So I took a small long position for a 1-to-1. So yeah, I'm essentially just looking for the same thing. If we can get some sort of setup on on the Euro Swiss, I'd be quite happy to take another long position. Again, as I've already said, the euro to me seems a lot more bullish than it was previously. I think there's a lot of repricing to still happen. We just need to see some more confirmations that the euro is actually going to pick up. And this isn't just like temporary data. And the Swiss is under some pretty serious pressure, actually. So we've got the S&B cutting rates, which is obviously dampening the appeal. The safe haven demand is there, but upside is limited. And it's just generally a lot weaker against its peers. The Nikkei is something I was looking to discuss, actually. So actually, I just need to open the Edge Finder. I don't think it's reading anything on the Edge Finder just yet. But the COT report is quite interesting. So again, it kind of ties into the yen long idea. If we're getting rate hikes or path back to normalization, it would generally make sense to look to short. So let me just pull this up. Yeah, here. So we can see smart money is short. So we can see they've been increasing the shorts week on week since the 21st of February. So we can see they've gone from a positive 1.82, negative 0.7, negative 5.48, negative 10.25, and now they're down at negative 7.76. Sorry. So it's slightly reduced in terms of negativity, but the idea, I would say, is still completely intact. The net positioning flipped, though. So it's no longer overall bullish. It's now actually overall bearish, only slightly, but it's still something to pay attention to as far as I'm concerned. So I really like the Nikkei idea. It's, again, just a case of waiting. I think just like the yen pairs, it's a case of just making sure your timing is really as good as it can be. So let's have a look. See if we could find something. So if we go to the daily and we just use the fib, so from high to low, we're actually coming into quite a nice level here. So we've got the 50% pullback, we've got previous structure around here, we've got a 50 and 200 moving average about to cross, which indicates a change of trend, nothing too major. So if we can see rejections within this area, I'd be quite happy to start looking to take a short position. And again, just keeping it quite simple. Be careful on yen. Retail is extremely long. I'll be honest, Marcus, I don't really care what retail is doing on the yen. Retail is quite often shaken out quite easily. And again, as I said earlier, I'm looking to hold for quite a long time. So that positioning isn't a huge concern. I'll pay attention to retail more if it's a short-term trade rather than a position trade. But obviously, it's still something to think about, especially if you are going for shorter-term trades. But yeah, that's it. That's all I've got to show you or talk to you about from my end anyway. Tesla. Oh, I heard something interesting about Tesla, and I say this every time. I don't trade stocks, so don't take this seriously. It was just an idea I heard someone talk about, and I thought it was interesting. So when Elon bought Twitter, obviously now it's called X, he, as far as I'm aware, he used Tesla as collateral, and Tesla's lost about 50%, if not more. Yeah, it's lost more than 55% of its value in a very short space of time, actually. In just this year, it's lost 55%. So when you borrow against an investment with a bank, they will normally start asking for the money back if that investment loses a certain amount of value. I don't know the specifics because I've obviously never done it. But if they start trying to get Elon to pay back that money rather than just holding it against Tesla, Will he lose control of Twitter? Will he lose control of SpaceX? Will he lose control of Tesla? I don't know. Like I said, it's just a thought. I really don't know. And I was thinking the same thing about possibly buying the dip, but I'm going to be honest. Tesla looks like it's in a really, really bad spot. And I don't know about the financials. I don't know about data and all that type of things for Tesla. I'm just talking about from what I see in terms of sort of PR and, well, yeah, PR. You know, there's signs going up in London, like full billboards going up calling Elon a Nazi. There's showrooms getting destroyed in London. I think the US isn't actually much better. So I'm not sure if it'll probably be fine. But, you know, if the banks or whoever it is he borrowed that money from start asking for money back, I think there might be some issues there. And I'll be honest, if I was Elon right now, I'd be shaking in my boots. SpaceX is more valuable than Tesla. It is, but you know, if he runs out of money, then what's he going to do? Doesn't matter really if it's more valuable, because again, if he's borrowed it against Tesla to buy Twitter, he'll lose two companies. I think Tesla is baby, really, isn't it? I don't know. I don't really like the guy. I don't know him, obviously, but I don't know. From what I have seen from him, I think he'd rather have Tesla than SpaceX. Please, I'm from Ghana. I'm a beginner in Forex. Do you have a video on how to trade and when to trade? Yeah, there's quite a few videos on my channel on how to trade. There's videos on everyone's channel on how to trade. What you've got to do is work out what type of trader you are, and then you can go and, you know, find videos that would work for you. So if you're a scalper, then I'm not going to be any use. But if you're a swing trader, then maybe you'll find my videos useful. Tesla is about as popular as COVID. That is true, actually. SpaceX gets this money from military contracts. I'm sure you would rather sacrifice Tesla SpaceX to continue. Interesting. Okay, didn't know that. I appreciate it, Bashi. Yeah, this is what I mean. I'm not trying to sway anyone's opinion. Again, you know, I don't trade stocks. I don't know anything about them. I'm just sort of giving out uneducated ideas here. NAS 100. So as I said earlier in the stream, I'm long on the S&P, and I think I'm going to take a short position on the NAS. Now, it wouldn't really be for any major reason. It would just be mainly to offset some risk, and because I like the technical setup. We've already had a really strong downside move. This would give me almost a perfect setup the way I trade. So it'd come into this 50% level, previous structure, 200 moving average, ideally an overbought RSI. Then I'd look to go short. But yeah, that's a very loose idea. So it's something I'm watching, but not really paying much attention to at the moment. Self-subordination, thank you, I appreciate it. It takes me, you know, it's funny, I spend probably 6 hours every Saturday putting those research papers together, and I don't remember any of it. I'll sit there and I'll just write everything down, and then I'll chuck it to ChatGPT just to organize it and clean it up a bit. And I've got, you know, I couldn't tell you a thing that's actually in there because I spend so much time just writing. By the time I'm done, my brain's fried. How important is the RSI? It's no more important than the fib or the moving averages, but they all work together. So I could still take, if it pulled up here and it met there with the moving average and the fib, fine, I could still take it. But without the moving averages as well, probably not. Maybe I would, but I'd have a little bit less confidence. Same thing with the fib. So it all works in tandem together. There isn't really one part that's more important. Although I would say probably that the fib is the main component. But yeah, there's no secret sauce to the way I trade. It's just simple indicators with some fundamental backdrop. Not buying the dip. Yeah, Marcus, I've bought the S&P. I bought the S&P on my investment fund, and I also bought it on my active trading portfolio. I've been buying the S&P for a while. I keep putting some money in every 2 or 3 days when it drops a little bit more. I've been putting money in. Need to learn confidence on the fib. Honestly, Shadow, I think the fib is probably the easiest thing you could use, and it's in my opinion one of the most effective. You literally just draw it from high to low, or vice versa. If you're buying, look for the 50% or the 61.8 or 0.618. And then that is what we call the golden zone. So that's where, if it breaks above, the trade's gone. If it doesn't reach, then the trade's gone. If it comes in and rejects this area, the trade's on, and we're in for some fun. But yeah, that's it. I actually have, and this is going to sound like a sales pitch, but it's 100% free. If you go onto the Elite Traders website, I added a banner on the top of the website where you can get a free video that explains this strategy in detail. So if you do actually want to learn it properly, then give me your email and it'll be emailed over to you within a minute or two. I saw the NASDAQ short idea you typed this out. I did indeed. That's true. Where is Sean? I've not seen him. I'm planning to buy the Dow at the beginning of April. Interesting, Marcus. Why is that? I don't disagree with the idea. I'm just curious why April exactly. Actually, this is quite a major level for the Dow. I think it's likely going to come higher, but if it doesn't, this would be a really nice break and retest of previous structure. I actually quite like this to the short side. I'm not going to short it, just to be clear, but I quite like the setup. He saw the future? Yeah, maybe. I think most people that watch this stream can see the future. We all print money. Yeah, the fib is good. And it's one of the reasons I say you should keep trading simple, because things like a 50% level on the fib or a 200 moving average or an RSI or a level of structure, there's people watching the same thing. If you're trading something that's really complex and really obscure, unless you're trading it and sort of almost like a quant, like an algo, you're more than likely not going to make money with it, unless you've got some crazy stats and things to actually, to make it work, like a statistical strategy. Because the whole idea of trading is just trying to find areas where people are buying and selling. And I don't mean retail people are going to get knocked out. I mean where people are actually buying and selling. The institutions, where are they going? And what are they looking at? And I promise you, when I tell you, they're not looking at FVGs and SMTs and order blocks and liquidity sweeps. They're looking at very simple stuff. They'll draw a trend line. They'll draw a fib. They'll draw support, resistance. They'll have a 200 moving average. They'll have a MACD or an RSI or some sort of oscillator. And that's it. And obviously that's always paired with a very heavy fundamental a very heavy fundamental reason for the trade. So that's why it works. As long as we can get an idea of the economies. So, let's say that we know or we are sure the Dow is going down. We just need to find somewhere to sell it. So it might be this 200. It might be the 50% level. It could be support, resistance. So yeah, that's why I'm in a very simple way of trading. Seasonality, break and retest. Seasonality, that's a good one. We're invincible. That is absolutely right. The macro force. Yeah, if you make money, you make money. No one can tell you you're wrong for making money. But I think the success rates in trading will be much higher if people didn't try to overcomplicate it. Let me just check what time I'm on today, or what time I need to come off today. 10:15. Okay, sweet. So you got Chris Pulver coming on after me, as always. All strategies can work if based on higher timeframes and fundamentals. Yeah, I'd say that's pretty much right. I think you could go even more broad. I think you could say anything, literally anything can work, but not everything will work. Because, you know, if you just take it on a statistical basis, you could say, well, as long as you have something that wins 50% of the time, you could just move your take profit up slightly or reduce your stop loss slightly, and then you'll have a profitable strategy. You could flip a coin to go long or short, and you could pass, or you could be profitable. Like the guy that used a chicken and the other guy that used a dog to pass prop firms. Obviously, those the animals don't know what they're doing, but it works because of random and stats, I guess. My SPX long looks good. That's true, actually. Let me just check on that one. It does. Let's have a look how much profit that one's in. About 800. There you go. Whoops. That way. Way up. There we go. There you go. I don't have MetaTrader open on my computer, that's why I'm showing you the phone. Just to, prove it. Okay. James, can you recommend me a good web for fundamental analysis? My website or the A1... the edge finder. It depends what you want. If you want like a report style thing where it's breaking down current economics and situations and political things, my website, because I put it out every week. Or if you mean like data and you want like an edge finder, then you use the edge finder. Shadow, good stuff. That's why most traders get fooled that they're a profitable strategy when they don't, because of a short-term handful of trades. I completely agree with that. And I think another layer on that actually is they will have a situation where trading is actually so easy and so simple. They will essentially buy when the candle goes up, sell when the candle goes down, or they'll use a trend line. They'll use something really basic and it'll work for maybe a month or 2 months or something. Then it'll stop working. They'll lose money. And then they'll go onto YouTube and search trading strategies, Forex. Then they'll come across all these other guys saying trend lines don't work. That's retail. You're getting used to the liquidity. You need to use what the banks use. And then they get sucked into that. It's like, oh, this is really complex and confusing. It must work. Because what I did was simple and didn't work. So that one must be the way to do it. And I think that's how it starts, really. But then, after a while, they'll come back and they'll be like, oh, maybe support and resistance and a fib or a moving average is actually the way to go. Seen a little bit of a slowdown here on pound New Zealand, so I might pay a bit more close attention to this. We've got the RSI oversold as well, which is a nice little confluence. 200 moving average is coming up. We've got sort of maybe a rejection here if we can see some more bulls come into the fight. Do I train? I'm not sure what you mean by do I train. It will work until fundamentals change. That's absolutely true. Short USD JPY. I'm short USD JPY actually. It was at entry earlier, but yeah, so it's in a little bit of drawdown, nothing too major. But yeah, I'm short that one. Can you check New Zealand CAD? Why is yen selling? People are selling. Simple as that. There's no real reason. The yen fundamentally is still bullish in my view. I wouldn't say there's any major reason. It's just the way the markets move sometimes. It is quite extended though if you look at it on the grander scheme of things. So it's normal to have ups and downs. If a market is bullish, it will still have periods where it drops slightly before it continues higher. New Zealand CAD. So I would lean more towards going long, yeah. So the reason is because although the RBNZ is cutting rates, I think the Canadian dollar is just in a much worse place. They're obviously, I've said it before, but they're in a trade war with the US, which is, in my view, just a net negative for them. It's like getting into a fist fight with someone that's 20 times your size. You might throw a punch in there, here and there, but it's either way, you're going to come out worse. So I think it's pretty much the same thing for Canada. So That's a pretty big thing, but we've also got oil. I've actually not checked oil this week. Yeah, it's not looking good. Although we've had a little bit of upside here, I'm still not confident on the outlook for oil. So New Zealand dollar CAD, I would be looking to go long. I just don't really see anything at the moment. You could maybe get in on the 50% retracement from the previous low to current high. But yeah, to be honest, it'd be more just a case here of now waiting to see how it reacts at this resistance. Is it going to reject, come back 50%, or is it going to break, retest, continuation? Either way, yeah, I'd be quite happy to buy the market. But yeah, at the moment, there's no setup just yet. I used to use the MACD all the time, actually. I used to use it instead of the RSI. But I just found the RSI to be a little bit more accurate or a little bit easier to read, to be honest. MACD is fine. But yeah, I prefer the RSI. I'm sure Elon has rich friends he can borrow money from. He seems to be friends with the president. Is he friends with Trump, though? Or, I also saw another video. It's like, essentially, Elon is the president. He bought his way in by proxy of Trump. I mean, again, I don't really look into that type of stuff. I don't care too much, but yeah, I don't know. I don't know what their relationship's like behind closed doors. Because if Elon loses his money and loses his power, is Trump going to want to still be, friends with him? Who knows? Gold. Yeah, we did cover gold, but we can do it again. So I would be only looking to buy gold. There's no reason really to sell it. The only argument, in my view, that is valid for selling gold is trying to catch a profit-taking dip. But that is risky. That's a very, it's more of a gamble, I would say. So the fundamentals for gold, or the drivers, what's been driving gold this whole time, in my view, hasn't changed really. We've still got trade wars. We've still got the Fed going to cut rates. We've still got uncertainty in the markets. So just because we've reached 3,000, it doesn't mean gold is now just going to reverse because we hit such a big key level. More than happy to say gold's going to go higher. It's just, a case really of just waiting now for when's the next pullback? When are we going to get it? Don't appreciate clickbait, no excuses. No worries, bud. I'm sure that one view will be completely fine with me. Don't worry. Oh, Ball Out's here. Hello. He's a lot of friends who buy options to get Tesla up. I literally saw it on the chart. Interesting. Elon is unofficial president. Yeah, that's kind of the way I see it, but again, I don't really look into that sort of stuff. It doesn't benefit me in any way. It's more just a fun little thought I've got. James took small gold sell on Friday with SL over the high. Very nice ball out. I was actually just saying, I'm not sure if you heard it, but I think we might get some sort of profit taking here. It generally happens when we reach all-time highs. Like here, we consolidated sideways, then profit taking. Now we're consolidating sideways. We're going to get some profit taking before going higher. I think it's valid. We'll see. Trump know what he's doing. Also, must both of them benefiting from each other. Yeah, I mean, I'll be honest. I really don't care about the political side and all that sort of stuff. It's more just, again, it was more just a fun thought about Tesla that ended up going into Trump and Elon. But I'm not here to discuss that type of thing. James just got to know about your website. Love the research section. No worries. I'm glad you like it. Do you think SPX bouncing and oil prices discounting might affect gold? No, I think we're good. I wouldn't really be a concern of mine, to be honest. I think if we can start seeing more of a risk on sentiment, then yes, gold might have a little bit of a tougher time continuing higher. But I wouldn't say it's going to stop it, really. The thing is, I don't really see any changes in market dynamics. So the S&P sell-off, nothing's really changed in my view anyway. We've still got trade wars. We've still got Russia-Ukraine uncertainty and whether peace is actually going to happen or not, because we've heard a lot about it. Nothing's happened yet. And the Middle East, we had Trump. Didn't Trump bomb the Houthis or something over the weekend? Obviously, it's not market moving really, but it just shows that there's still problems going on. Yeah, ball out. I think we've got the same idea. I'm not going short, but I definitely see some downside on the table. Any idea on CAD yen? Yes, I would say CAD yen's still got room to the downside. As I was saying earlier, we've still got a trade war. We've still got oil taking a little bit of a dump. Yeah, long-term bullish on the yen. So if we could come up, I might take a short position if we can come up to here. I'd have to use a large stop loss on this one. And then just look to see if we can break. Yeah, look, see if we can break this support level through here. But yeah, it's pretty simple, actually, to be honest. There's nothing complex about the CAD or the yen right now. Still think indices have another push down. To be honest, Paul, I actually wouldn't disagree with you there. I'm not sure. I mean, I'm already long on the S&P, but I am also looking to go short on the NASDAQ. So either way, if we can just come up a little bit higher, and then if we start selling off, fine. I'll be positioned either way, so I don't really care after that. Hey, James, not sure if you already talked about it. What are your thoughts on dollar yen? I'm short dollar yen at the moment, actually. It's looking a little bit rough. It's essentially just side. In fact, I took this trade live on stream last week on this stream, so some of you may have seen me take this. But yeah, nothing's happened. It's just sideways moving. So right now, can't really tell you anything. Fundamentally, still very bearish on dollar yen. Again, I'm bullish on the yen. It's trending higher. Yes, we're down today. We've had a little bit of a dip, but the trend to me is intact. The dollar is very clearly taken a hit, and to me, it doesn't look like there's any interest in buying the dollar right now, to be honest. So I think dollar yen shorts are still a great play, but again, it's going to take some patience. James, here's a good from April towards the end of the year. AUD USD buys building that slowly. Ball out. Again, we're on the same page. It seems like we're on the same page today. I'm already in the long. So my current take profit is at 0.645. But if we can see this trend and trend nicely, and we don't have any issues in terms of the dollar starting to gain strength again, I'd actually really happily trail this trade, actually. Because I was saying at the start of the stream, it's had such a large sell-off just since September last year. It wouldn't be a shock to me if we do see maybe not a full correction. I'm not saying we're going to come back up to 0.69 anytime soon. Anyway, we definitely could in the long term, but maybe even just up to 0.669 possibly. I don't know. We'll see. But I'm positioned long, so if it continues in terms of the macros in bullish sentiment, I'll happily hold the trade. Hi James, how long have you been full-time Forex trader? I've been trading for, I think it's coming up to about 8 years. No, 7.5, roughly around, I'd say 7 to 8 years. I've been trading on my own or full-time for 4 years. What year are we in? 2025. Actually, I'd say about 3.5, 4 years. Yeah. But I've also got other businesses, so trading isn't the only income I've got. It's just one of the incomes I've got. So I'm not really sure it's fair to call me a full-time Forex trader. JPY sideways and playing games. Indeed it is. It's shaking out the paper hands. We will get there. We will prevail. if you can hold your trade. That's a risky thing to say. It's not financial advice. Yeah, I think that's the plan ball out, actually. I'm quite happy to keep selling the dollar. No issues with that one. I think I'd rather diversify a little bit, though. So I'm not sure I'd want to go in on, keep stacking Australian dollar, US dollar positions. I think I'd rather go Australian dollar, US dollar, pound US dollar, and euro US dollar as well. Trump doing that also bad for DXY, right? Because they kind of go into war. Well, actually, Bashi, war benefits the US dollar. It's kind of tricky to gauge if the dollar is risk off or risk on, because you've got times like war, yes, where it does benefit, and you've got times like now where there's trade war and we are risk off, but the dollar's also dumping. But yeah, if there's a war, I actually wouldn't be shocked if the dollar does quite well. Patience, tiger. Yeah. Yeah, there's not really anything else I'm paying attention to. But I've got just over a little bit, 10 minutes. So if there's any questions or any markets you want me to go over, let me know now or forever hold your peace until tomorrow or the day after, whenever I'm next on. Yeah, US arms deal. Yeah, the US is big on war. Let's put it that way. Euro, US dollar. Yeah, so with euro dollar, I don't expect much of a higher price. Excuse me. Yeah, I don't expect much of a higher price than euro dollar. It seems a lot of, or all of the positive news really is priced in now. We've had almost a 6% move in the past 2 to 3 weeks, which is large. We've obviously got the stimulus German stimulus. We've got a less restrictive ECB policy. We've got the US dollar taking a dump. But, as I said, it seems to be priced in now. So I would expect some sort of correction on euro dollar, maybe even just 50% of the move. I don't know. But from there, I'll be looking to buy. So bullish on euro dollar. It's just a case of, really just waiting, because I'm not gonna buy it now. Shorting euro US dollar probably wasn't the wisest move unless I was hedging. Fundamentally not, but I actually am short euro dollar. Very, very small. When I say very small, it's like 0.05% risk. It is really not even a position. It's more just to see if we get the move. Like a little gamble, I guess you could call it, rather than a speculative trade. Is Max here? Don't think so. As a day trader, I'm long euro dollar. I think long euro dollar is definitely better than short at the moment. James, how many pips you look for in swing trade? Mohammed, it doesn't work like that, my friend. Pips are completely irrelevant. Pips are calculated differently on different assets. So if someone tells you, I see this quite a lot actually. If you're seeing someone that's selling a service like mentorship or signals or whatever, and they're saying you can make 100 pips a day or 20 pips a day or 1,000 pips a month, just run. Because it's probably actually one of the biggest red flags I've got for a trader is if they talk about pips and not percentage. But on a swing trade, in terms of percentages, I will look for 1 to 1.5, 1 to 2. That's about it. I don't really have an interest in catching huge moves. I'm happy to get in, get out, and if there's another opportunity, I'll get back in, like I did with Euro Swiss. But I don't really like to hold trades too long. My TP on the S&P, I don't have a TP on the S&P. So the S&P trades on a Darwin account. So we're happy, when I say we, it's the guy I'm also running that account with. We're just letting it run. So there's no stop loss, there's no take profit. We're just letting it go. So if it continues to run, essentially if it continues nicely, we'll hold it maybe for another year, maybe 6 months, maybe 5 years, who knows? We'll see. A lot of traders talk about pips. It's fine to talk about pips. When I say it's a red flag, I don't mean, oh, I made 10 pips on this trade. I don't care about that. But if they're saying, join my service, you will make 1,000 pips a month, or this is how to make 20 pips a day, normally it's a load of rubbish. Because when you're running a portfolio, your default measurement should be percentage. So you would use a benchmark index like the S&P. You would say, oh, the S&P did 10% this year. I did 11%, so I outperformed the S&P by 1%. Or whatever, whatever you're trying to do, it's normally measured in the percentage terms, not pips. No one cares about pips. So if I went to an auditor and said, I made 1,000 pips on, or I made 1,000 pips this year, they say, well, what asset, what risk, what I need more context. Anyway, oil shorts. I do quite like the idea of oil shorts. I was short oil not too long ago. I took one stop loss and I took one win. So these were the two positions. I cut this one short because I didn't really like the way it was moving. And this was a stop loss. So I actually ended up almost break even. This is a 1% loss. This was a 0.75% gain. So, not a huge deal. But yeah, I like the idea of shorting oil again. If we can find, in fact, this might be quite a nice level. Yeah, something like this, I actually don't mind. But then where's the target is the question. Where would I want to go? Stop loss is way too big because I need to have a smaller take profit, really. Probably just back down to previous lows. So I'd maybe do a 1-to-1, at least 1 to 1.5. Yeah, something like that, maybe. I don't know. We'll see. I'm not sure I'll actually take it, but yeah, we'll see. Can't stand trading gurus that talk about profit in purely terms of money or pips. Yeah, I know. Well, the money thing is a smart marketing move, actually, because obviously it gets the emotions running for the viewers. But so I kind of understand that, as long as they also talk about the percentage. But pips, yeah, it's meaningless. RNI is bad for oil short. Yeah, that's what I'm thinking, Marcus. It's not really there. Windows, yeah, I don't. I don't think I could go back to Windows. Can you put Edgefinder risk sentiment? Yeah. Wait, do you want fear and greed, or I guess you want this one? Yeah. The JP lays down the law. That's a good way of saying it. Yeah, but I use Mac. I just feel like Mac is just more professional. He wants to, you don't want to go to a business meeting and whip out a ThinkPad. you want to go to a business meeting and pull out a MacBook like a real man. How do you live without Windows? Like an adult. It's quite simple. I'm joking. I know I don't want to start the whole Windows versus Apple thing. I'm only joking. Actually, I'm not joking, but there you go. I've got to say, well, that is the sad thing, is MetaTrader on Mac is awful. It's probably the worst, most painful experience I've ever had. But it's a sacrifice I make for the greater good of being a man. Ooh, professional. Yeah. Of course, Mohammed has to be different and use Linux. No, the only reason I use Mac on a serious level is because it all syncs together. So I've got an iPad, iPhone, AirPods, everything just connects. I can play music on my phone without having to connect to anything that you go straight to my AirPods, or I can put a film on my laptop and go straight to my AirPods, or I can airdrop something to my phone. It's all just seamless. Whereas, if I had an iPad and a Windows computer, it's not going to work the same. And I'd feel it would ruin my workflow. FTSE buys. Yeah, I don't know. I don't mind the idea. I just don't like the FTSE because it's just, I don't know, it's just a horrible market. I mean, look at how long was this? This was from May, or let's just say, okay, so June 24 until January 25. That's all we got. It's horrible. It's an awful market to trade. So generally, I stay away from the FTSE as much as possible. I actually can't remember the last time I took it. Can my Apple do what? FTSE like sideways action, it does. Yeah, I think it sounds like we're all in the same idea. FTSE is just awful. DAX shorts. I don't know. I was skeptical about the DAX. So I was looking at, I think it was this actually. Some of you may remember when I was talking about this level, and I was saying I like it, but I'm just not sure. I'm not confident in the idea, and the reason is because that was when the Green Party were pushing back on the stimulus in Germany. But it seems like they've come to an agreement, so it's benefiting now. So I'm actually quite liking DAX longs, but I just don't have an entry. I'm really actually annoyed. I mean, I wouldn't have taken this anyway. Obviously, like I said, I was too hesitant. But in hindsight, I missed a perfect entry or ignored a perfect entry. Self-substantiation, no worries. I'll see you soon. Will Trump calm down, or is he on a mad one all year? I think he'll calm down eventually. It might take time. My moving average is 50 and 200 EMA. That's really pessimistic. I think the deployment of stimulus will fail just like everything else in European Union right now. You know what? I actually don't really disagree, but I don't think it's going to fail. I think the European Union or Europe in general it's failed. But maybe this is some light. I don't know. The markets seem to think so. And who am I to argue with the markets? JP is coming this week. Indeed, he is. I don't think he's going to necessarily be dovish, but I'm not confident in the US economy right now. I've seen a lot of talks, and I put a tweet out about it. I've only got like a few seconds left, so I won't go into it in too much detail. But there's been a lot of talks about recession, and I think that's just a lot of investors being snowflakes. I think it's a huge, what do you like, clickbait really by all the news outlets and people just being soft. I think it's fine. We've not had a negative GDP, especially 2 quarters in a row. Retail sales are slightly down. Business confidence is down, but yeah, not going into recession. I wouldn't say it yet anyway. But we did have lower inflation. So that might be a little bit of a dovish sign from the Fed. We'll see. Yeah, I wouldn't expect him to be hawkish. I think it will be very neutral. I think he will do what he always does. We're data dependent, inflation tick down, blah, 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 blah. Labor market's fine. I don't think we'll really get anything. Media faking us? Yeah. It's faking all the paper hands. I mean, as Nick said before I came on, smart money's been buying the S&P. You know, if they were really, really concerned about a recession, they wouldn't be buying the S&P. If anything, they'd be stacking short positions on. So that's a pretty good sign for you right there. Cal, I'll be honest, mate, I don't have any time left. I'm just waiting for a message to say Chris is here, and then I'll be gone. So I don't want to get into a whole different currency. Maybe Chris will go over it with you, though. So I apologize about that. Ball out, that's a really good analogy, actually. I quite like that. FTSE on spots trade. Yeah, I think I'd rather trade the DAX, to be honest. I'm not really bothered about the FTSE. If I was going to go into a European market, it would definitely be the DAX. US economy is slowing, so there's recessionary whispers. Excuse me. Yeah, Lee, that's what I mean. I'm not confident about the economy. I'm definitely not saying it's strong or it's great, but I wouldn't say we're on the side of a recession. Do you trade exotic pairs? Mohammed, no. I keep my trading just like my strategy, very, very simple. It's pretty much just G10s, a little bit of gold, a little bit of oil, and that's about it. Oh no, maybe the S&P here and there. DAX on the 5 minute. Wow, it's rocketing. I'm going to get FOMO out here. Well, like Buffett says, when people are fearful, we get greedy. Oh, wait, this is the 5 month. My bad, not 5 minute. Yeah, it's actually not really doing anything. Okay. I think the message just came in. Guys, Chris is here to take over the show. So I appreciate you all being here as always. You've been great to talk to. You've definitely started my week nicely. So guys, don't get margin called. As always, I'll see you all very, very soon. Stay safe and subscribe to my channel. I'm trying to reach 5,000 subscribers by the end of the year. Thank you very much. See you later.
Hey everybody, thanks for tuning into today's A1 trading session. We love engaging with our audience, talking shop, taking requests, and sharing our favorite setups. It's about that time where we're going to review a bunch of indexes, stocks, currencies, gold, silver, Bitcoin, and pretty much anything else and share our insights. If you're wondering what trades I'm in, if you're wondering what trades I'm taking, and you'd like to see exactly how I'm trading everything, you can actually follow my trading signals. If that sounds like something you're interested in, we'll share a link in the chat and you can sign up. You can sign up directly with the link or speak to a support rep if you have any questions. If you're asking, what do I trade? Pretty much everything. Indexes, ETFs, stocks, options, futures, Forex, and crypto. Thoughtful analysis, active trading. Check it out. And now, back to the show. What's happening, everybody? Happy Monday. How we doing? It's going to be a pretty wild week ahead. A couple of weeks, actually, to get through Q1 and end of the month expirations. So having a look here, my copper position maxes out around $160, and I've got $150 to show for it. So it's about 86% of max profit. It's way out of the money, so there's not really much I have to do for it for the next 38 days. But if I want to take the profit, I can. Put on some hedges. That's going to be important. I think we'll talk some big technicals today. Watching Bitcoin pretty closely. I have some. This is a little income trade for next. Next Friday. So max profit 67. I'm up about $40. I'm going to free up some buying power here. I did some puts on this. So I've got 67 cents. Should be probably trading for like 27 cents or less. Let me see what I can get out of here. 28 cents. Let me see if I can get out of here for 28 cents. 28 cents. Go 29. 30. I'm just going to take the 50+% profit here. Don't make me go to the ask price. That's embarrassing. You're a better broker than that, Tasty. 31 cents? Come on, dude. 32 cents is the ask price. All right, close out for 32 cents. Getting some buying power back. Okay, so that was a little income trade on IBIT. Other ones are looking fine. Fine. This is out to May. This is out to May. Has some shares collared, whatever. Okay, good. Now, let's talk some positions. I do have to get a snap rolled. So this is Snapchat trading at 875. I've got a call this Friday at 950. That's 94% already in profit. But I'm just going to go ahead and roll it. And let me just double check my break even on Snap. So let's go to the tracker, Snap. All right, so my break even is 912. Let me see if I can do a quick roll on this one. So roll this out to the monthly expiration for April. April 17th is 16 cents credit. I get 46 cents on this one. This wouldn't be terrible. So if I go 912 break even, minus 46 cents, 866, get it called away at 9. And I've got 300 shares. I make a little repair there, $100. Not awful. I mean, are we getting back to $10? Let me check on Snap real quick. Trading at 874. I mean, I'd like to think in this like $8 zone, there's at least a squeeze. I mean, we've had solid earnings growth on Snapchat. I don't know why they're not having any type of profit unless it's like they're just spending crap tons on AI. But you know, there's revenue. They're beating EPS. They've done that for a lot of. I mean, I don't know. I'd like to see them do better. This is a COVID crash low around 850. So, I mean, I think we have some support here. So possibly, let me look out into May. This one's, it's not costing me an arm and a leg. If I go to the May 16th, get it called away at 10, that's not awful. So let's do 9.12 minus 57, get it called away at 10 on 300 shares, make $435. I'm okay with that. All right, I'm going to do this. So I'm just going to roll my 950 call that expires this Friday. That's mostly in profit. It's only trading for a couple pennies now. I'm just going to roll this out to May and up to $10, and I can still get 55 to 57 cents in this trade. See if they'll be generous and fill me at 57 cents in this roll. 57 filled. Okay, so that's good. I'm going to update this right now. Rolled to 5/16 expiration. $10 sell call for 57 cents credit. So that break even is 855. All right, so that's a rollout on Snapchat. Let's talk technicals on the bigger picture. Why do I think this week is so critical? All eyes on the Fed, although they are not likely to do anything. What they say, language-wise, comments, Powell's, press conference is going to be important to kind of lay out the groundwork for what they're looking for, expecting to do this year. Right now, the market's pricing in 3 cuts. I will take a screenshot of this right here. Let's go take a screenshot of the FedWatch tool for today, March 17th. March 17th at 10:25 a.m. Eastern Time. Okay, so I just want to reference this. So that way, after the Fed, we'll obviously watch what price action does. That's the most important thing to me. It's not really what Powell says, it's what the market prices. I don't know what he's going to say that's really going to, give the market a reason to rally. I don't know what he's going to say that's going to give the market a reason to fall. If they come out with like a hawkish tone, then yeah, I can see the market falling because the Fed's not being accommodative enough. We're already worried about Trump and tariffs and the current administration, basically gutting all government spending. And that's the extreme. Like, it's not actually happening. The government's still going to spend a crap ton. We're probably still going to have a fiscal deficit, but it's the optics of having Doge there that has, $1 trillion+ in mind, $1.5 trillion in mind. I've read some pretty surprising stuff over the weekend. In 2024, what I read is 34% of GDP was government spending. 34% of US GDP, 34% of US GDP came from government spending in 2024. That's a record. If you exclude crisis, you exclude wartime, you exclude crisis, that is a record. So we are operating from a fiscal policy standpoint as if we are in a crisis mode, recession mode, wartime mode, and we're clearly not yet, but still, unsustainable is probably the easiest word to explain it. I get what's happening as far as like why do we have the need for it. I just think that it's coming at a pretty terrible time. But that being said, I want to make a reference to this because now that fiscal policy seems to be on the decline, and we don't know how bad that's going to get and how bad this administration could potentially exacerbate those moves. But if the Fed, which is potentially going to be cutting rates this year, are they cutting rates into a recession? Maybe, and maybe it's not a Fed caused recession, but the Fed will still be cutting when the market's still down anyway. So overall, here's my concern, and this is what I thought a lot about last week. This is how I kind of positioned a lot of my portfolio for the rest of the year. If this market is going to be, finding some lows and finding some resiliency, hooray. Do I think the all-time highs are possibly going to get tested this year? Maybe. I'm not sure if I shared this everyone on Friday last week, but let me go into this chart here. Okay, a couple things. Typically, if we get through the little lull of February and March, usually by March, April, the market picks itself up. We get a seasonal trend. This is called the pre-summer push. April, May, June, July, some of the biggest bull runs ever. So usually from, this is 70 plus years of trading. You get a nice seasonal trend right in here. If that is absent this year, we should all be hoping for a good Q4. But if it's absent, I don't know. This is all bets are off. This is like just going to be one of those years where you hope you don't get burned too badly. You're playing defense, and that's exactly what I'm doing. So point is, if we can get through this, which we had a nice little cleanse, the market was down 10 to 11% on the S&P, 13 to 14% on the NASDAQ, nearly double digits on the Dow. We've got the Russell down nearly 20% or right at 20%. I mean, that is in fact, I think I read this. This is the sixth fastest decline. So from peak to trough of over 10% on the S&P, that's the sixth fastest time it's ever happened. So, and again, does that mean anything? Not really. It just means that our cycles are so much more accelerated now that things move faster. But I don't think that the bottom is necessarily in. If we're going to have resiliency, what do we need to see? We would have to have inflation trending lower, Fed willing to cut. We'd have to have the consumer willing to spend, and the consumer still have jobs. Okay. If this can happen, and I'm saying the consumer as in like not the federal government worker, that cut those layoffs. I mean, I think right now Doge has I don't know if we actually officially had the layoffs, but to what I'm reading, about 60,000+ jobs right now. It could be way worse. There could be hundreds of thousands of jobs. But for private sector, if we still have the consumer employed, we still have the consumer willing to spend and willing to kind of maintain cost of living standards. I mean, we probably need to see a housing market resiliency as well, which we're starting to see some applications picking up. But inflation trending lower, we saw that last week. Does it continue that way? We'll find out. The Fed is willing to cut and be a little bit more dovish and accommodative. Okay, fine. But I think this is going to be needed for the markets to stay resilient. Okay. If all of a sudden we see that the consumer is unwilling to spend and consumers are losing jobs, and we're starting to see initial jobless claims ticking higher, we're starting to see continued jobless claims ticking higher. If the housing market is still kind of frozen, if interest rates aren't going down too much, if the Fed is, the Fed could be willing to cut, but in the wake of a recession, the Fed is going to be cutting and the market doesn't really care. The market's going to drop regardless. So the Fed isn't necessarily going to be saving the market, in my opinion. I don't think. So a Fed put could be way lower than what the market is sitting at right now. Everyone's talking about the Fed put, the Fed put. Right now, it's not even a Fed put. It is a Fed put and a Trump put / administration put. If there's no backstopping this market can clearly have a pretty nasty correction. Again, I'll look at the bigger picture, but I've already looked at like a 20% area that seems pretty doable to the downside. And that's not going to be a lot of fun for anybody, but I'm just saying that wouldn't be a huge surprise to see us ultimately get there if a lot of these things are kind of this current changing of the guard. This is becoming like the new normal with a austerity-driven administration, at least for the first 6 months, 9 months. Again, I think they're on borrowed time because midterms are going to depend on what they can get done. If nobody's happy with this current administration for the first 2 years, you're going to notice it in the midterms. You're going to have this big pendulum swing from one side or the other. It's going to be, all Republicans, and then it swings back to Democrats, and they lose the House and they lose the Senate. There's no more majority, and then you're right back into nothing can get done. And then Democrats maybe come in swinging, and they're trying to put things forward. You got a president's going to veto everything. Like, it's going to be back to gridlock again. Political circus is always happening, right? But point is, if we have a correction, we have an intermediate low, that's understandable. My biggest concern is that this is a setup for more bad stuff. And this is what's scary about the markets. The reality is everything could be okay, right? But the market is always forward thinking. And if the market thinks that there's a recession, if the market thinks there's more job cuts coming, if the market thinks that consumers are going to be struggling and pulling back, the market prices that in. That's the downside. Even if we would technically not be in a recession, the market could show it. 6 to 8 months forward thinking. So that level of resiliency needs to be communicated now. Because if it's not, this market's going to start pricing in things that are worse. Or this reality that's kind of lining up for 6 to 8 months from now. If we don't get better news, then the market's going to price it in. And I don't think that this little 10, 11% correction is going to be the lowest. Now, historically, something like this I thought was pretty important. That it's not necessarily where you start, but it's how you finish. So we're off to our 18th worst start since 1928. And those even these crazy terrible starts. Look at this price return for the first 48 trading days. You notice some of these levels, like, yeah, they're awful, right? 2009, right out of the great financial crisis. 2020, that was during the COVID OPEX cycle from February to March. It's a horrible window. 1935, I don't even know why, right? Great Depression was 1929. But 2022 was the start of a bear market after a deleveraging that happened in late 2021. So we're off to a pretty rough start. So at least in my my career, my era, I saw that happen. I saw that happen. I saw that happen. And I saw that happen. I saw that happen. And here we are now. I'm watching it live. Even 2000, watching it live. So point is, we've had of these 17 worst starts. Of these 17 worst starts, 10 out of 17 times, the market still finished the year positive. So, and it's not an awesome stat, but it's about 58%. So is that a big enough edge to say I'm going to put all my money on the market finishing higher for the year? I mean, it's a calculated bet. But I'd say if you're at least protecting the downside, then yeah, you've got probabilities on your side. You've got time on your side. If anybody's looking, let's say 3 to 5 years out, there's really not much to worry about. If you're looking 3 to 5 years out, there's not much to worry about outside of don't lose your butt if this market's going to fall, 20, 30%. Worst case is if we fall 20, 30, 40, 50%, I mean, there's a lifetime of wealth that can be generated in that type of drawdown. But the problem is are you going to survive it? And that's where most traders don't. Is most traders are already overextended and already over leveraged, and it's that decline that makes them panic, and all of a sudden they lose all faith and confidence in the markets, and they get out, and all of a sudden that 100% upside they'll never feel, and they'll never experience it. So, and look, that's why if you think about it, like most like self-made millionaires are people with 401ks for 20 plus years. That's the craziest thing about the dollar cost averaging approach and just staying in the markets regardless, is those consistent flows of wherever the market is, up or down. 20 plus years in the market, it's done pretty well. You can go back any stretch of time. Yes, you've had some ugly drawdowns, but most of the time over a 20-year window, you could have the worst possible buying level and still make money. So I'm not saying it's easy. And it certainly feels like crap to watch this market if you're, now becoming more active in your portfolio and you are dealing and navigating with a potentially a massive correction. It's not fun, but just saying, um, time in the market helps. Time in the market helps. So there is a slight possibility that yes, the market finds some resiliency, finds some lows, and we deal with like a bunch of noise. And this might be, the low might not be in, but we might have like a bear trap, and then it gets back above the 200, and the market finds a reason to move. Do we get back to all-time highs this year? Yes, no, maybe. My biggest concern right now is looking at the bigger picture, zooming out, and we have previous all-time highs back in 2021, 2022. This is on the S&P. The NASDAQ would be the highs back in 2021 in November. But my biggest concern with that is that this level is now just going to be the play zone for the bears to, try to maintain their control, and the bulls will just end up running out of resiliency. And so the bears take over, and then this open space, this probably would feel worse than what we just experienced for the last, 3-4 weeks, because there's nothing to stop it. Outside of this August low, there's really nothing to stop this market. So that is certainly my bigger concern in 2025, 2026 is if we start breaking some critical levels, we can give back a lot of gains very, very quickly. And, I need to make sure that I'm playing defense for that. Okay. All right. Lee's asking, at what point does the correction become a bear market? The textbook definition is at 20%. So we are in, correction mode is always considered anything, I'd say the comfortable correction mode would be between about 5 and 10% would be correction, because that's very common. You get like 10 to 15, you're talking, deep correction. And you're talking 20 plus, you're talking bear market. And now it has to be like you have to see a shift in direction. The 20 plus percent is don't catch a falling knife. If it's 20 plus percent, it could get worse. I'm not saying that 20% is automatic. Hey, buy the dip. Historically speaking, if you give yourself, again, 3, 4, 5 years plus, if you're buying with a 3 to 5 year outlook and you're already starting at a 20 plus percent discount, the odds of making money are very high in your favor. But if you start buying at a 20% discount and the market still drops another 10, 20%, okay, you still got to ride it out. Does it get back to all-time high? I mean, that's the journey, right? So it's never a clear path. It's never easy. But a correction market to a bear market, that's why bear markets are usually like over fast, is because they're so violent, so ugly. And again, I don't know what's going to happen, but I do know that if the market is going to be dropping, I want to be making sure that there are ways to alleviate some of that pain. So for example, I've got some hedges on right now that it's about 1 to 2K in risk to pay out anywhere between 6 and 10K in profit. That's on average. So just keeping the number simple. So if I put in, 10K on a hedge that has the ability to pay 60 to 100 grand. I mean, that can offset and alleviate a lot of pain for me to then, play defense, button up some exposure, not overtrade, and just, also be kind of braced for more downside and just be patient. That would be, I mean, the best approach might be yes, I'm going to actively trade through things, but if this market turns over, like I will be actively selling this market. And that becomes pretty straightforward with like bear put spreads, bear call spreads. There's all sorts of fancy ways, but like what I don't want to do is be consistently calling the bottom, because you never know how fast and aggressive this market can fall. All right. But point is, I mean, there's corrections. We've been spoiled by these like 1 and 2% dips, 1 and 2% dips, 1 and 2% dips, and they have worked. But a 5% correction, which we saw in April last year, a 10% correction, which we saw in August last year, now looking at another, 10% correction, what we saw in these last like 4 or 5 weeks. If we get into deeper territory, double digits, 20% is called bear market. If you get the death cross with a 50 period and the 200 period in there and they're crossing over, that's the death cross, that if the market can't respond with a move back above it, then look out below. right? And so we're not there yet. We're not in death cross territory because it happened so quickly. These are moving averages for a reason. So right now my 50 period is probably this one. Yep. So my 50 period is right here with all the little dots on it. So my 50 period is here and my 200 period is here. So we would have to flop around here for a while to have maybe everything come in coiled, and all of a sudden we get our moving averages coiled. Maybe we put in an intermediate low and the market's not going anywhere. And then the next part is, well, if it breaks and goes lower, there's where this thing accelerates again. If it breaks and goes higher, then maybe there's a little bit of relief. I don't know. I mean, seriously, if the Trump administration is using the markets at all for any barometer of approval of the administration sentiment, they should be careful on how much animosity and adversity they cause in the markets. They should be careful. And they're saying that they're not. Trump hasn't tweeted at all about the markets. They've said expect there to be. I don't care. I'm not getting the politics here. It's nothing I can control. But this is a recession. There's no ifs, ands, or buts. If we're going to be down, 15 to 20% in these markets, there's going to be a recession. And the bad part is this recession could be felt a lot differently because you've essentially had 4 years of consumers just scraping by, knowing that things are not really getting better, and now it's just getting worse again. So that reset to the consumer could be all the more hurtful than it was back in a mortgage crisis when people had 3, 4, 5 homes that couldn't afford it, and that was just a bubble waiting to happen. This, I don't know what you call this one. This would be, I don't know. I would feel rough that this would probably be like the worst like Main Street recession that we have seen, since 2008. 2008 was awful, okay? But this could be one of the worst Main Street recessions because consumers have been basically living on debt, dropping all their savings. The only money they have on paper is sitting in their home. But because everyone refied during COVID and they're sitting at sub 4% mortgage rates and they're squatting in their homes because they can't afford to move. Prices are at all-time highs. Interest rates are still crazy high. But if prices have been passed on to us and we've been able to live and survive, at some point it's like, screw it, stop spending, cut back. And what you don't want is you don't want a consumer to lose jobs. If we start to see a recession with job losses, it could get really bad. So again, like, I'm not pricing that in, but I've got to be hedged just to be on the just in case. There's definitely a just in case scenario with my trading this year. Until things get, and this is the hard part, until things get more clear. I don't know when that's going to be. I will say that there's some pretty key deadlines here from the technicals. Right now, JP Morgan, one of the biggest investment banks in the world, they have a fund that typically has, it's called the JP Morgan collar. Okay. And it usually runs about 40,000 SPX contracts. And that provides a resistance level in the market because it's where a lot of option flows will gravitate towards. They're hedging towards it. They're hedging off of it. Resistance level, which would be sell calls. And then you have your support level, which is going to be your either your buy puts or your sell puts, that all your option flows are going to go on. So, I mean, granted, I know this isn't the only game in town, but big market makers and big institutions are oftentimes positioning off of this. And right now for March 31st, so 3/31 expiration, which is not today or next week, but the week after. So we've got the 17th, the 24th, and the 31st. That is going to be your quarterly expiration. So that's going to be your Q1 expiration. Right now, that put level is 55.65. So at least for the next 1 or 2 weeks, 55.65 should be acting as proper support. Okay. Does that mean I'm getting crazy aggressive off of that? No, it doesn't mean that at all. But it means that based on where I see the option orders coming in and the gamma levels that I'm watching on my charts, I could see that level being a reason that this market found a bounce. Right? We came down right around 55.50 or so. What was our low from last week? Thursday was our last low. Yeah, Thursday was our low, and that candle was 55.04. 55.04 is a little bit of an overshoot from that 55.65 support level. So I could see that holding, and I wouldn't be terribly shocked if by the 31st we're still sitting above 55.65. Right? And then what's going to be interesting is that day or going into the next week, because 31st is Monday, then you go April 1, 2, 3, is you have a couple other key levels and deadlines. You'll have end of the quarter. So you'll have 331 or early April. You'll have a new JPM collar. Okay. Or you'll have a new levels. And so if we're sitting, around these lows, because and I was roughly guesstimating this, but by the turn of the end of the year was around 5,900. Turn of the year is around 5,900. So if we looked at this like 55.65 as it's about 335 points lower, and I'm imagining that pretty comparable to that, it's going to be somewhat delta neutral, a 335. If there's any skew to that, maybe it's slightly more to the upside, but depending on where we are at, okay, let's say that we are hanging out around like 5,700. Well, based on current environment and current volatility, there might be another 300-point move lower and another 300-point move higher, right? So that new collar position, or that new kind of resistance level at the call side and support level at the put side, might be sitting at 5,400, right? 5,400 is obviously lower lows, but it also makes me a little bit more nervous that it's just more open. There's just a lot more open space below, let's say below 5,400. A lot more open space. So this is something I'm going to continue to kind of monitor and track. It's not foolproof by any means, but when it comes to market makers that have been trading options since 1970s, this is their job. So if the market is going to be falling aggressively, they are properly hedged to make sure that they can still make a market. If they don't do their job, they go bankrupt, right? So they have to have the money, the cash, the inventory available to provide liquidity to the market. That's why these levels are so important. Okay. So point is, where we are sitting coming into Q2, like kicking off April, where we are sitting will be pretty important. Because if we're up here towards like 58 or 5,900, then we might see that support level just a little bit lower and that resistance level sitting just above these highs, and the market's right in the middle. We could come down and test the lows again. We can maybe, I mean, I'd say the higher probability is that we come and test the lows again versus retesting all-time highs. If we retest all-time highs, I do think that somehow gives the market a big sigh of relief. Otherwise, we're setting up for like another, here we go again, like just another big roller coaster ride, but I don't know. Okay, so there's that. And then on top of that, you come into April, which I want to say it's April 2nd. So April 2nd, we have retaliation talks on tariffs. Okay, so what happens between the US and Europe? What happens between US and additional retaliatory tariffs in Canada, Mexico? Mark Carney, if anybody knows, I mean, I don't even know what his job is right now for Canada. Is it prime minister? Is he prime minister? That's right. Or is he just like finance director? I have no idea. Mark Carney. But he's been from Canada to the UK. He was like the Bank of England's guy for a while. Right now he is, so he's the Prime Minister of Canada. Okay. He was the Bank of England's director for many, many years. I want to say he was the Bank of Canada's director for a while. I don't know. This guy's been in and around. It's whatever. But Canada's not just rolling over. I don't know. It's just so much crap, man. It's so much crap, and we got to trade through it. But there's stuff that matters this week. The Fed is this week. Price action matters. We've had this huge decline in the last, 6 weeks of trading. I do think there's a short-term rally. The sentiment has been really, really extreme, right? I mean, I read from Steve Sosnick this morning, Interactive Brokers. When you get the AAII sentiment survey showing the extremes that it is for like 3 straight weeks, usually, Bank of England governor. That's right. I mean, it was for a while. It was like during Brexit. He was the guy during Brexit. Probably not a fun job. But for 3 straight weeks, we have seen this was literally like at this high level, this differential, about 40% difference between bears and bulls. We're talking like 2009 levels, like post Great Financial Crisis, when the market did rally pretty hard off the lows. But it's not the same. history doesn't repeat itself. It often rhymes. And the sentiment swings are really, really extreme, which does tell me there could be some bounces coming. But market breadth wise, I don't think the worst of it's been priced in. So I'm not overlooking the fact that we may not be in for the bottom. If it is the bottom, freaking great. If it is the bottom, then trading is easy. If it's not the bottom, it's how much more pain is there ahead. And I just don't want to be caught on the wrong side of that without having some defense plays. And that's hedging, and that's lightening up positions. It's having cash at the ready to deploy at a much better price. So my job is simple. Just don't do anything stupid. If we get pleasantly surprised the upside, awesome. But I'm just not crazy aggressive right now. I don't want to be. I shouldn't be. I think there's more uncertainty that I need to navigate, and I certainly don't need to overexpose. Okay. All right. So anyway, that's what's going on. Between this week, Fed on Wednesday, here is your snapshot. Does this change at all? I'm going to compare this on Wednesday after close or Friday when we're wrapping up the week. Does this change at all? Right now, I mean, the likelihood of a cut in March is pretty much non-existent. So there's likely not going to be anything. But what we may end up seeing is this June and July, maybe it shifts. Right now, we have about an 80% chance in May that nothing happens. Does it shift? Maybe the first cut is in May, and then the next cut is in, who knows? If it shifts, watch. But if that is somehow explicitly said, I doubt it. But if this is somehow what the market is sniffing out and pricing out or pricing in, that might help give the market a little bit of a boost. That if the market's anticipating 3 cuts, maybe the Fed is willing to cut a little bit sooner. I still don't think that's the greatest idea because I still think there's more data that needs to happen. We still have inflation data that's sticky as heck. So we're just in this crazy environment. And meanwhile, I say all this and it's just like all this focus on US. Look, a lot of liquidity and a lot of options that I trade in the biggest markets in the world are US based stocks. The S&P 500 is one of the largest markets in the world. It's the most liquid market in the world. So for me to say like, well, I'll just trade Germany. I'll just trade the Euro Stoxx 50. I'll just trade the FTSE. I'll just trade. It's not the same, So the tools that I have to trade are a lot different. I mean, you have Mag 7 or your top 10 stocks in the US that are larger than most developed countries' entire economy. So that's how large the US market is. So when it comes to the trading and options market, I still like US equities, but there is a clear rotation going on right now. And I think the important thing is this is also an interesting trend that if you look back to the first like 50 to 75 days of trading, any sector that's been leading typically takes the reins and runs for the entire year. So if anybody's looking to diversify this year, rather than being in tech and rather than being in what is not doing well, energy is probably positioning for, and energy to me is a question mark because if we break the lows of $60, energy is not going to look great if oil prices are dropping. So this is probably my least favorite diversifier right now, although I do have some energy plays, and I'm going to take a look at that in a second because I have some puts on XLE. XLE. Okay. And those are looking fine. I might end up closing those. I think they're either this week or next week, but I'll double check that. But the other sectors that are looking pretty good, healthcare I like, and utilities I like. Okay. Materials, maybe. I mean, we're slapping tariffs on steel. Aluminum prices like Alcoa. I follow Alcoa. I like Alcoa when the market's rallying, and Alcoa is kind of garbage right now. But materials, I mean, copper, aluminum, steel, tariffs aside, it's like if there is a demand for these things, I don't know. It's not a bad play. And this is also like classic rotation away from discretionary when people are scaling back and away from tech, which is typically your growth cycle is starting to slow. When growth is starting to slow, discretionary is where the consumer cuts back, and technology is the rip roaring, paying the high valuations for basically overvalued stock. It takes a big correction. So I think healthcare is probably one of my favorite. Healthcare has been one of the most consistent sectors for jobs as well. I think it's going to continue to need more. I mean, I think insurance is a joke, but it's our system. I mean, we don't have universal health care, at least comparable to Canada or comparable to Europe. We can argue it all day long. It's not fun. I mean, I don't know how everyone feels about their insurance in the US, but I'm certainly not a fan. But it's what it is. Point is, these tend to trend and lead the way. So if we're looking out 12 months from now, this may be the leading sector for the year. You're looking out 12 months from now, this may be the leading sector for the year, right? So what are these? These are typically non-correlated to the S&P. These are typically much lower beta than the S&P. So let's show that. Let's go to XLV. XLV with a beta of 0.44. That's, half, right? So it's way less correlated to the S&P. And you go to XLB for materials, and you're looking at a 0.75, a little bit more correlated than I'd like. Let's go to utilities. XLU should be a very low beta here. 0.39. Yeah. So if you want to be diversified and have like way less volatility, healthcare, utilities, pretty good. Energy is trading up to 90. These expire at the end of the quarter. So I've got an 83 2-in-1 put for $1.41. I think I closed these out already, but let me double check. So XLE, nope, I still have them in. So max profit's about $1.43. I'm up about 55%. I'm good on that. I'm going to let those expire at the end of the quarter. So that should be fine to let it expire. But yeah, I mean, it's not that difficult. There's still going to be some pain. There's no guarantees that just because this is green is going to stay green. If this is more red, this is more red, this is more red, then this probably goes flat, flat, flat. But it doesn't perform worse, right? It may not perform well, but it might not perform worse. And that is still considered defense. So, sectors to consider. Energy, probably my least favorite though. Healthcare, utilities, possibly materials. Materials a little bit more beta, so it's close to correlated, which I don't love. But utilities I really like, healthcare I really like, energy. I don't know. Energy, if we go from, fossil fuels into nuclear, if we go, I don't know. I mean, I think with Trump, I think the clean energy stuff is done. Like this administration probably could give two shits about clean energy. It's driving oil prices down. It's drill baby drill. And U.S. and Saudi Arabia are the two countries that can have the highest market share with low oil prices, and it's going to cause a lot of pain. I don't know if that causes a war in the near term. I don't know, but probably energy as a diversifier, yes. Non-correlated, yes. But if we get below $60 and break major support, I don't know what that looks like. But healthcare, utilities, probably some of my favorites. Okay, Euro stocks. So DAX doing well. FEZ. So I had kind of a deep dive on Euro stocks this weekend. Obviously, this is what I think good exposure to have. I'm in the FEZ. I don't mind participating in this. My only concern is that Europe is not really spending money on infrastructure. They're spending money on defense. They're spending money on weapons. That's not a multiplier. Spending money and building a weapons armory and building like a wartime war chest is not a multiplier for GDP and for growth. So I get it that the money is going elsewhere, and it's kind of vacating the U.S. and what's been overvalued, and money's going to where it's been just super undervalued, and Euro stocks continue to be undervalued. But I would hope that the spending that's going on, like the kind of the opening the fiscal wallets up in the Eurozone, I'm hoping that's willing to go into like programs to grow GDP, programs to build infrastructure, programs to make the Eurozone better, as opposed to it's a war zone. I mean, somebody referred to, I was listening to a podcast this week, and they referred to the Eurozone and war zone as like the kind of the white people's Middle East, which in a way with Russia, Ukraine is kind of true. But anyway, I mean, I don't mind having the exposure. I think there's maybe other sectors or other areas to go that may look a little bit better. But I still have FEZ exposure. I don't mind showing that, yeah, this could still outperform. The FTSE has been okay. It's pulled back a little bit. The FTSE is showing some resiliency. We're just pulling back to some dynamic support levels. But as long as we stay, I'd say, stop loss wise, if the FTSE breaks below these lows, like I don't want to be in it. But if we are going to stay with higher lows and lots of consolidation and higher lows and consolidation and higher lows, higher highs, not a bad spot. There's a recent dip here to buy off of. So we'll see. Copper. Let's go copper futures. Copper futures just rip into the upside, which is, I mean, fine. I like the position I took. It was a little income trade that's almost like 90% profit, which is fine. I don't know how much more bullish I'm going to get on copper necessarily outside of participating in some of these like pullbacks. And then gold. Gold is at 29.97. You know, I think the big wonder is like if gold is just going to be this like gangbuster rip. Maybe it is. I still find that gold, from a technical standpoint, if we are going to enter into some type of capitulation move, we've already stretched a decent amount of way. I measured this out a lot last week. A 15% move higher than this moving average is quite extreme. So I took a position on this one last week where, you know, we're sitting up around 14+% above the 200 moving average. We have 350, 360 bars right now above the 200 moving average. So I am basically positioning for a bit of a topping pattern in gold. However, that topping pattern, I'm not having any type of threat until price is above 32.50. So for me on gold, I don't have any risk on this trade unless we're trading above 32.50 by like April 24th. So it's a short trading window. If this is just straight bullish, then yeah, maybe there's some risk here. But if it just pops up here and then consolidates, then my trade is fine. I also have a bull call spread. So if we go up, I have a profit trap and then I take on risk at 32.50. So that's an income trade. I'm still waiting for pullbacks. I'm hoping we have some. I mean, this is crazy. This is only pulled back to a 21 moving average. And most of these pullbacks here for the last like couple of years have been next to nothing. Like these pullbacks since this breakout in 2023, it has been at best the 21 and the 50 moving average. Okay, right here we pulled back to the 100. I think we tapped the 100 right there. That was it. And that was just a little wedge that broke out again. So 21 continues to offer up like really dynamic support. And it's kind of crazy. So anyway, I still gold is a great diversifier. I don't know how silly and crazy gold gets. Gold is certainly one of the best performing assets so far for the year. If you go up to the 12-month candle, gold is probably outperforming most indexes right now, certainly outperforming Bitcoin. We are sitting here with gold at the start of the year. I mean, I don't even see a wick. The low of the year at 26.14. So we have a wick that's 10 points lower. So this thing started out with a close for the year, a little blip hesitation to the downside, and this thing has been just straight up. So gold from open to current is up 14+%. I mean, it's keeping pace with some of the best indexes in the world. And for a, you know, safe haven seen asset, that's pretty remarkable. And for the yearly chart, I mean, this is also a interesting stretch. This low to whenever we put in some type of high, it's like this cycle 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. This is 10 candles. So I don't know. I mean, do I think gold looks good? Sure. But I want to have gold in my portfolio. I just want to buy at better prices. And I'm hoping that I get them. If I don't get them, then I guess I'll just continue with the melt up and enjoy gold being this like amazing safe haven that you hope the world doesn't freaking crash. And then gold's, I mean, I don't know. Obviously, gold can get even like gold can go ballistic. I think that's the scary part is we don't know if gold's going to turn into like a Bitcoin type rally. You know, I mean, even this, like it's up 14%. Okay, big whoop. But if this year turns into a 14, 20, 30, 50% correction, or not correction, but a rally, I mean, I don't know what the biggest rallies per year have been on gold. I would imagine we haven't had too many like 30, 40+% years. What's some of the biggest years we've had on gold? I'd imagine a big gain on gold to be like 20 to 30%. Let me look at some of these, you know, monster candles here. So 2010, gold was up about 30%. That's a big year. This low to high volatility, that was a 47, 48% move, but a lot of volatility and ended up being a fade move. We obviously had a huge crash here in 2013, 14. Don't really recall why gold crashed that much, but it was down 28.5%. And then it built back up. We saw some gains. There's another big candle to the upside, about 25% that year. Last year was a very bullish year for gold. Gold was up and it beat the market. Gold beat the S&P for the first time, I think, in a long time. I think, yeah, I mean, it's crazier, 26+% from what I'm just roughly measuring there. All right, anyway, let's see what happens to that $3,000 handle. I think everyone's talking about it. Does it really mean anything? Does it show any type of resistance? I don't know. I still look at the stretch away move from this bar count. Unless we're going like parabolic or exponential type rally on gold, I could see this, I don't know, just maintaining bid, but just kind of stalling. It depends on, I guess it depends on if big institutions are coming in saying, look, gold still looks attractive, buy it. You know, the amount of central bank buying on gold has been increasing dramatically the last probably 3, 4, 5 years. And if there's more, institutional money flowing into gold, then we're probably seeing another, nice bull market on gold. So something to watch. I, for one, hope that the poor man's gold, silver, continues to look pretty good to the upside as well. I'd love to see if we're going to have a bull market in gold and continue to stretch, I'd love to see silver doing the same thing. If silver can get up into the 40s, I would be thrilled, because that's a pretty decent gain in my portfolio when I own the thing down here in the 20s. So anyway, and then there's Bitcoin. What's it going to be? It's either the, greatest asset ever / equalizer of those that missed out for the last 20 years of American exceptionalism, to having some type of asset that's going to change the world. This is all, take it with a grain of salt. But I really think that Bitcoin this year, especially, critical resistance becoming support. If we do too much damage below this like $56,000 mark, if we do damage below these levels, my concern is that that is a monster top, and we're going to see like a 70 to 80% correction of Bitcoin. And all that will be left will be your Bitcoin enthusiasts down here that are willing to basically just walk away, put their tail between their legs, and not look at it for a while. And then all of a sudden, maybe Bitcoin is up. But I would say for the institutional side, with ETFs and BlackRock having its hat in the game, Michael Saylor's essentially his entire reputation rides on Bitcoin, because that's the only way MicroStrategy is profitable right now. If this level holds and this semblance of a trend can hold, then sure, Bitcoin looks better. But I don't think you get Bitcoin bulls without a broader market. It's like, maybe I would say bull market. You'd almost want to see a bull market in the equity space in order to have Bitcoin also look good. But if we see additional drawdowns, that risk on will just get pulled out of the market. This is where deleveraging is really obvious. Yep. So it's true, Lee, but also with China too, it's like now it's telegraphed what China's doing, and I think China's hopefully looking to buy. I mean, calls are expensive, man. With this increase in volatility that we've seen, this swell in volatility, calls are more expensive, puts are more expensive. If you're paper trading it, but obviously the physical gold it's at a premium. So, but who knows? I mean, if gold's going up to $4,000 an ounce, then it's still a good investment. So we'll see. All right. Anything else for today? I think I covered a lot. It's just kind of it's big picture stuff. What's important this week? We've got the Fed on Wednesday. Unlikely to change, but what is the language that they give us on Wednesday for any type of upcoming rate cuts? Are they, pretty certain about 2 to 3 cuts? Are they going to actually say anything explicit? Does Powell leak any type of transparency in the market that the market runs with? From the technical side of, S&P, it's a pretty simple swing from high to low. We are at the 236 pullback right now. If the market can somehow get back to this like 30% zone or 38% zone, this is a little bit of sigh of relief, is pulling back to like the 38 to 50% pullback zone. I still think the market's going to be met with a lot of resistance in here. So at best, I think the market, if we pull back to, let's say, like 5,800 to 5,900, that's probably the at best pullback in my opinion. But the concern is that the bears are just so ready and so eager that this thing hits like 30% and then just retests the lows. That's my concern. And not just retest the lows, but claws at the lows. And then there has to be like this, drama at the downside. And is it going to be volatile? And like, buckle up, because there could be all sorts of head spinning volatility in the coming weeks. Like I said, that quarterly expiration, the seasonality. I mean, I don't think this is something to ignore. Typically, the market does have some good seasonality, which would mean like April, May, June, July usually have a pretty good run. But if there's nothing optimistic to price in, I don't know how the market really rips. I could see the market stabilizing, but what's the market going to rip on? Maybe a pullback, but still not enough to take out any all-time highs. And then we come into August, September. This is where we're talking about the big like refi bubble in 2025. That's going to be the big refi bubble that the clock is ticking on the Fed with whether or not they're cutting rates, and are they cutting enough rates to make it worthwhile to then finance and refinance at affordable levels. So if we're not fixing things in these next couple of months, then I don't really have a super positive outlook for the end of 2025. That's it. So we'll see. But all right, continue to grind as usual. Let's do it again tomorrow. All right, thanks. Bye. Okay, we're gonna let this dead air run. Chandler, James, I'm gonna wrap it up. I got a class in 5 minutes.
Thanks for watching today's A1 Trading Show. Be sure to subscribe and to turn on notifications so you don't miss the next one. Want more from A1 Trading? Check out the links in the description below, or our website a1trading.com. We have lots of free trading tools and channels available for you. We hope you have a great rest of your day, and we'll see you tomorrow.